we'll start to get into the part of the programming where we pick some real winners and losers.
Hyperscalers will have to show more signs of pricing power and monetization.
A wide swath of the market has been largely overlooked by investors.
The pace of earnings is just not going to be what it was.
Money will rotate back into tech.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, facing down a huge week. Mega-cap tech lining up for the biggest week of earnings season. Just as the Kevin Walsh Fed is gearing up for a family fight, the Trump White House is hitting pause on striking Iran, sending stocks higher and oil down.
Yeah, so maybe not sending a signal for the rest of the week, but the headline roulette, the Mune music is looking better than expected today. As people say, 2 nights without strikes gives a sense that maybe negotiations are back on. And as Nathan Sheets of Citigroup said over the weekend, this leans into the idea that this administration does not want to kick up oil prices any higher ahead of the midterms, and that is the default position. Try to de-escalate this, giving people a sense that maybe that will happen. That said, we don't know how well inventories are doing and just how much of a glut or a lack thereof there is to cushion whatever may be ahead.
Make it day 3. Is it about diplomacy? Is it about something else? Not the midterms, maybe. It's about the ammo. According to reports over the weekend, it might be.
When it comes to the New York Times, Wall Street Journal, they're saying that there's a debate right now within the administration about depleting stockpiles of munitions, and that is why they had to hit this pause at a time when the president was foreshadowing that he wanted to go against and expand the targets that the United States was attacking on Iran.
Think about the week we've just had. Triple digits on crude, back into the 80s now. On Brent, 87 and down by some 9 percentage points. Think about the moves we've seen in the equity market. Bring up the board and look ahead to these mega-cap tech earnings across Wednesday and Thursday. And think about this one name and the price action on Friday. Intel. Intel absolutely crushed it. And we were talking about it going into the opening bell on Friday. Watch how this trades. Got hammered going into the weekend. What does that tell you about price and positioning and about how high this bar is for some of those names?
Is it getting insurmountable, given how much has already been baked in, given the fact that Intel performed really well immediately after earnings and then was down more than 7% on Friday, as people say, look, we're going to take some chips off the table, literally, excuse the pun, it is Monday. At this point, you have to wonder if the bar is incredibly high because of whether, just because the performance has been so good, or whether the bar is so high because of CapEx. And ultimately, people are getting a little bit of heartburn over the fact that they're spending trillions of dollars, and the amount just keeps going higher.
It's my favourite week of the quarter. I know for most of you it is yours as well. How do you rank it? We always talk about that coming into this week. How would you rank this week? What's top of the pile, the Fed or tech earnings? I think most people at the moment would lean slightly towards the tech earnings this week.
The tech story is the everything story. It is the U.S. productivity story. It is the dynamism in the U.S. economy. It is efficiency. It is inflation. It is the entire gains of the U.S. equity market so far over the past couple of years. If that is waning, that is going to be a game changer. It isn't so much, as you said before, exactly what the earnings are. It is exactly how the market responds to it. I want to know the total number of CapEx. How much does this keep climbing, and what is the intolerance of this by capital markets?
I'm going to go with the Fed because I would love to watch this family fight. And I want to see how Kevin Walsh addresses the press when a number of if they hold,
sure,
when a number of individuals have come out and talked about the rationale for hiking rates right now.
Haven't got a massive move in the bond market this morning. You've seen that move in crude down by 9 to 10%. Let's call it around 10% lower. And at the front end of the yield curve, you're down 3 basis points, still around 430 on twos. That tells you a lot about the two-way risk into this meeting. Consensus overwhelmingly is hold. But there is this small margin of risk, this two-way risk that this new Fed chair has introduced to make this a live meeting.
Well, yeah, right now we've got more than a 30% chance that potentially they're going to hike rates on Wednesday. There's almost a certainty that they're going to hike rates on September. People will say, that market price isn't exactly a certainty. Goldman Sachs has come out and been pretty vociferous about this, that the bias is still to hold. That said, people are taking a look at the sticky factor and the impatience that Fed officials have with the idea that we just keep being well above that 2% target. And at what point can you just not use the T word or even imply the T word, even think the T word, or people are going to come after you?
Shut it down.
Yeah.
Back to that again. Shut down that word. 3 to 4 basis points lower across the yield curve this morning. The Fed meeting just a few days away. Coming up this hour, Seema Shah of Principal Asset Management heading into a big earnings week. We'll speak to the former Deputy National Security Advisor Victoria Coates as the US and Iran pause strikes. And Blake Gwinn of RBC expecting a hawkish hold from the Federal Reserve. We begin this hour with stocks bouncing back going into a big week for mega cap tech. Seema Shah of Principal Asset Management Goldman writing, there are already early signs that a rotation trade may be emerging, with the latest tech-led sell-off benefiting the financials. Seema joins us now for more. Seema, welcome. I believe it's 8 consecutive weeks of gains for the bank sector on the S&P 500. What is it about the tech sector that is so compromised heading into this earnings season?
Hi, John. Well, I think, we've been seeing over the last week or two, as soon as the earnings started, that, look, they're delivering. They've got the strong earnings, but the market wants more than that. They want to see that the cash flow is not turning negative. They want to see return on investment, and that's really the main thing now. And so as a result, the mood is souring a little bit. It doesn't mean that the AI capex trade, the whole theme, is finished by any means. We do believe very strongly that it's going to be very significant for global productivity growth and global businesses. But at this juncture, with these kind of valuations, I think there are other opportunities in the market which are worth looking at, and certainly financials, banks specifically are one of them.
Can we just sit on price and positioning as well? We mentioned Intel. Intel had fantastic numbers heading into the weekend. The stock was down at the close as of Friday. Seema, what did that tell you about price and positioning, and not just that name, but others as well in that sector?
Yeah, look, you can just look at the market right now. The positioning at the moment from the tech side is everyone wants it, but there's a little bit, there needs to be more space to go, which is running out. So people are looking beyond and saying, look, we know that earnings growth is really strong, but can it really continue at this kind of pace? And are we nearing a bit of a peak? So that's where we're seeing the turn. And I think from the intel, from actually all of the companies that we've heard from the tech side recently, it is still the focus on CapEx. People don't want to see that additional push up in CapEx. They want to know some certainty that this is actually going to be realized, some kind of monetization of AI. And I think that's really the key narrative that investors are looking for right now when it comes to the tech sector.
One thing that Mike Wilson of Morgan Stanley came out over the weekend and was talking about is that some of the beneficiaries of the efficiencies of some of this technology are going to be the real winners, financials being among them. Some of the other areas like software that potentially could be disrupted the most by them could potentially also win. Do you agree with that?
Yeah, I think that's a really interesting perspective. And I certainly, when we're looking across the way that we've been investing over the last year or so, potentially longer, is really about thinking who are the beneficiaries. We know that the tech build out is going to be really key, but what are the suppliers? What is the supply chain towards that? And also, who are the people that are the companies that are going to be benefiting from a productivity side? And that's actually when you can look beyond the US, beyond South Korea, Taiwan, to other parts of the world, even including Europe, which do stand to be a beneficiary. So there are a world of opportunities. And particularly right now, when there is investor interest starting to wane a little bit on tech, this is the time to be looking beyond your traditional winners that we've become accustomed to over the past year or so, and start thinking beyond into other segments of the market and other segments of the global market.
Where does oil fit into this equation? We're talking all about technology and this sort of secular sea change, and then you overlay the volatility that we're seeing in oil prices. Do you just ignore it because it's not something that you can really calculate?
No, you absolutely cannot ignore it. And, this is a real toss-up for investors. You started the hour talking about what's more important, the Fed or the tech earnings. And actually, I do think the Fed, in light of the move up in oil prices, is really key, because as we've been seeing the rotation take place in the last couple of weeks to other segments of the market, that has to be driven on a constructive economy. If you were to see a rise in rates over the next couple of months, particularly if the market starts to sit as a sequence of hikes, well, then that really would test that rotation that we're seeing in other segments of the market. So no, you cannot ignore it. It's very difficult to predict, but there has to be some kind of consideration there.
We're down almost 9% right now on Brent crude. What does the Fed do when it comes to oil that's acting like a yo-yo?
Well, this is one of the reasons for our perspective is that you cannot change rates this week. You have to stay on hold. Trying to make a decision based on a policy which can turn hour by hour doesn't make sense. Of course, the consideration is on core inflation, second round effects, but unfortunately, that's not going to come through for a couple of months. So to our minds, it makes sense to stand still. But given that this is coming into the week, 30% odds from market pricing is almost a bit of a toss-up for the Fed in that regard. So where we're looking is that there's very, very little margin for error in terms of where the inflation path goes from here. So it really is going to be a data-dependent, month-by-month process of looking how inflation is performing. And of course, the main thing being is where are the second-round effects coming through, if at all.
Seema, I think it's also worth stressing that oil is only one piece of the story. one piece of the puzzle for this Federal Reserve. And I think you can see that. That's a story in and of itself in today's price action, that you can have a move of 9% on crude and a move of 3 basis points on twos, which is nothing. Nothing. We're back at 430 on a 2-year after threatening to break through, 440 in the last week. 10s are still around 460. 30s are still well north of 5%. What is it about the yield curve right now that is just keeping things elevated for longer, regardless of this volatility in the crude price?
I mean, one thing is just the level of oil. I mean, we're talking fine. It's a 9% move. But ultimately, you're still looking at oil prices, which are really, really elevated. So, of course, from that perspective, if it were to stay at that level, then you're going to see through a feed through to core inflation, which is going to be really uncomfortable. But beyond that, the market is also just looking and saying, look, the economy is really strong. We saw from jobless claims last week falling to really low levels, that there is a chance that you're going to see a labour market tightening. So this is a number of things which are going into the decision. But certainly as we're looking to this week, to Wednesday's decision, at this stage, given that so much of the inflation outlook is driven by what's happening with the conflict, it seems a little bit too early to be making any concrete decisions on policy.
Seema, it's good to see you. Thank you. Seema Shah there of Principal Asset Management. We're tolerating this in financial markets and in the economy as well, at least so far. Since the war started as of Friday, 10-year yields were higher by something like 70 basis points. We've priced out cuts, we've priced in hikes, and look at the performance of financial markets and the real economy. The equal weight on the S&P over that period, slightly positive. Consensus growth expectations stood around 2% for GDP, and unemployment is getting closer to 4 and further away from 5. That tells you a lot about where people see financial markets going and how the economy is materialising as well since these twin shocks, both in crude and in rates.
And one thing people have pointed out is that actually there's been a very unexpected acceleration of the labor market over that period of time that people really had not anticipated and didn't make any sense given where oil prices were. It is counterintuitive and it is against history to see how much the labor market has recovered. I will say, just to sort of lean into the tech story for a second, it still is related to the tech story and issuance. Because on one hand, it's also the economy being robust, but it's also a wealth transfer, people borrowing money and then investing it into the economy. Issuance is coming from the tech sector. It's also coming from the U.S. government with 2- and 5-year auctions today. It's just, this is a complicated story with a lot of different facets.
We're raising a lot of capital, fueling a lot of growth. We'll get into that later. Let's get you up to date on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. The U.S. pausing strikes against Iran for 3 straight nights now. U.S. Ambassador to the UN, Mike Wolfe, saying President Donald Trump is giving diplomacy, quote, some space. Iran also halting its retaliatory strikes and holding talks with Oman over the Strait of Hormuz. DeepSeek has put its fundraising plans on hold for now. Sources telling us here at Bloomberg the company's founder is frustrated over online posts by Chinese media that he reportedly made about a June funding round. The unverified reports say he discussed a reliance on Nvidia chips and also China's lag in AI relative to the United States. Chinese chipmaker CXMT surging more than 460% in its trading debut. CXMT is China's largest producer of DRAM, the chips used in devices from servers to cameras. It ranks just behind SK Hynix, Samsung and Micron. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thank you very much. More from Vonnie in about 30 minutes' time. I'm next on the programme, easing tensions with Iran.
We're locked and loaded and ready to go, but we're talking to them, so I think while we're talking, we'll see what comes of it. Despite what everyone says about the election, I'm not in a hurry.
Up next, we'll catch up with the former Deputy National Security Advisor, Victoria Coates, live from New York City this morning. Good morning. What do they say? Decades where nothing happens and weeks where decades happen? Too much, maybe. But it's a big week ahead for financial markets. It looks like this. A Federal Reserve decision on Wednesday. Check out that earnings lineup. 4 names, almost 1/5 of the index. Crazy. Wednesday, Microsoft, Meta. Thursday, Apple, Amazon. That's your setup for this week. Those events right there. The pricing of it looks like this. Equity futures positive, a bounce by 1% on the S&P 500. On the Nasdaq, up by 1.6. Stocks up, crude down, and crude once again in the driving seat this morning. Brent and WTI. Brent heading lower by more than 8%. 88 on Brent crude this morning, 83 on WTI. So what is that worth in the bond market? It's worth a couple of basis points. Twos out to 30s this morning. Twos down 2 or 3 basis points to just 4.30. That's not engineering a major rally heading into this Fed decision.
A lot of the increase in yields and, frankly, the increase in expectations from the Federal Reserve to raise rates came from something other than oil. Oil was a peripheral matter. Ultimately, the CPI and PPI that was softer than expected that we got 2 weeks ago gave people hope that maybe they wouldn't have to hike rates. The fact that we've had oil prices jack back up raises that prospect once again. Even an 8% decline this morning isn't going to change the minds and hearts of people who have been concerned about too high inflation for too long.
For some on this Fed, this is a feature, not a bug. This was by design, heading into this Fed meeting. Just a little bit of two-way risk, no hand-holding. It's over. The post-GFC experience where you got guided into each and every meeting, that's finished with this new Fed chair.
Yeah, and ultimately, is it going to be a problem, or ultimately is it going to be a virtue, create some volatility to potentially suppress borrowing costs, suppress borrowing activity? That said, unclear exactly how long they have the luxury to keep going with this two-way risk, and at what point they've got to signal something, especially if the balance of risks really becomes clearer in the market.
Let's get to that move in crude. Brent crude down by more than 8%, under surveillance this morning, easing tensions with Iran.
Look, we're talking to them right now. I think they're getting more and more serious as the days go by, for maybe the obvious reason. We're locked and loaded and ready to go, but we're talking to them, so I think while we're talking, we'll see what comes of it. Despite what everyone says about the election, I'm not in a hurry.
So here's the latest this morning. The US and Iran holding attacks for a third straight night as the Trump administration says the naval blockade in the Strait of Hormuz remains in full effect.
Absolutely. And what's happening right now is that naval blockade remains in effect, but the strikes have stopped for a third straight night. And you asked the right question, Jonathan. Is this about diplomacy or depleting stockpiles? Potentially it's a bit of both. We've seen the president want to take the diplomatic route in the past, but there's reporting from the New York Times, from the Wall Street Journal, that the reason why they decided against what could have been a 2-week intensive campaign against Iran was because of depleting stockpiles as we enter, what are we in, 5th month of war right now. And that is where the concern is for this administration and potentially why they had to hit pause.
The knee-jerk reaction for the press down in Washington, D.C. is often the same. It's a home bias. It's about the elections. It's always about the elections. The president has pushed back against that continuously. And based on the initial action to begin with, you'd have to stress it probably might not be about the elections.
If he believes that he has an advantage going into this, and frankly, if there is a more existential question here, you have to imagine that there's something else at play, especially because he does seem to be losing patience, according to a number of different reports. This isn't just about munitions running out. This is about strategically what the actual attacks by this ammunition will do, given the fact that there aren't enough anti-aircraft missiles to really be defensive should this go on for a prolonged period of time. It's a risk calculus that's changed the longer and the faster they can deploy strikes in an AI era.
Let's build on this conversation. Joining us now is the former Deputy National Security Advisor, Victoria Coates. Victoria, always appreciate your insight and your perspective. Welcome back to the programme. To what extent do you believe that US stockpiles are shaping the president's approach to this conflict?
Well, good morning, Jonathan. I actually don't think that it's that big of a factor. I think we have plenty for this particular engagement. I think long term, this is an issue we have to deal with revitalizing our defense industrial base, making sure we're producing what we need, and also making sure our partners and allies, we can provide them with the licenses so they can provide additional stockpiles for us. So I think that's a longer term question. I think right now, actually, the thing that is giving the president a little bit of pause is, of all things, the funeral of Senator Lindsey Graham. We're going to have just a parade of world leaders coming to Washington over the next 48 hours for that event. And they're all going to come to the White House and meet with the president. And so I think what he's doing is giving that a chance to play out. He's going to hear what people have to say. It's really going to be kind of a unique circumstance here this week that'll give him the chance to sort of take the global temperature.
Victoria, though, that hasn't stopped him in the past. I was with the president in Ankara at NATO, where he decided to resume bombing Iran, and he was surrounded by world leaders and was not even in the Situation Room at the White House.
Oh, no, I mean, this can play out different ways. But I think because we have this particular situation, we're going to have the Prime Minister of Israel, for example, we're going to have the president of Ukraine. just a number of different voices. I just get the sense, Annmarie, that this is going to be a couple of days to kind of, as I said, take that global temperature. I mean, I don't think it discounts what happened in Ankara in any way.
Do you have a sense of where we are in terms of the DoD's level of stockpiles of anti-missile interceptors? Interceptors, yeah. No, I mean, there's such... I mean, one of the things that's a little bit frustrating about this, there's such a wide range of these things. It's not just like one kind of interceptor. There are large numbers of different ones. But I mean, one metric that I find helpful is, for example, the PAC-3s, which are the interceptors we use with our Patriot systems. We make about 60 of those a month. Right now, Ukraine, not anything happening in the Middle East, Ukraine fires off 70 a month. So that depletion is an issue. Particularly for the Patriots. But as I said, we've got the Aegis systems, THAAD. I mean, you can go through the alphabet soup. So there are tons of different ones. And where one particular inventory is that's not in my skill set. But overall, I think we're fine. I think it's more of a long-term issue that we're looking at here. They're still fighting on other fronts. We have the Houthis over the weekend going after Saudi Arabian energy installations. Where do you see that part of the conflict developing?
Right. And so for the Houthi went after a refinery installation for Saudi Arabia. And that's, that can potentially be a real problem because you can have all the crude in the world. If you can't refine it, if you can't turn it into gasoline or whatever other product you need, you can't drive it. You can't use it effectively. So that has to be watched. But the Saudis hit back pretty strongly against the Houthi. Important to remember, the Houthi are not 100 feet high. They're kind of Stone Age type people. That should be a manageable problem. And then the Saudis also have been quite ingenious, actually, about how they're moving around that problem. And they're starting to move a lot of their oil through the Suez Canal. So they're going up through the Red Sea rather than down to where the Houthi are. And it's been very interesting to me to see how, yes, the problems with Bab el-Mandeb and the Strait of Hormuz are bad, and they are influencing markets. But at the same time, that oil seems to almost squirt out of the Persian Gulf. It's finding alternate routes. And I think you will see that trend continue.
What's the best resolution in your mind right now? What do you think is a best case scenario that could potentially happen over the next couple of weeks?
I think the best case scenario is that we actually double down on the economic pressure on Iran. The reports coming out of the country continue to be quite dire about what is happening internally. And those are problems, Stephanie, they can't fix. And so I would say keep that blockade on. I would say keep trying to find these alternate routes to make sure the energy that we need from the Persian Gulf as a global market keeps coming out. Keep our domestic production very, very strong, and just continue to build that pressure internally on Iran, because they at this point are in such a degraded state that they can't really even begin to start to rebuild absent a very large international sort of support system. So I would double down on Secretary Bessent's Operation Epic or Economic Fury. And I think that's where we're going to see the best progress.
Victoria, it's good to see you. Thank you. Victoria Coates there, the former Deputy National Security Advisor under the Trump administration. Crude this morning down 8%, back to about 89. It persists, both the volatility and the elevated levels, and that in and of itself is a pretty big problem for policymakers and for financial markets alike. And
the idea of the actual ammunition stockpiles is an important one, because it isn't just about whether they have the capacity to keep bombing. It's the question of what are the resources of a nation to protect itself should there be additional conflicts or some sort of flare-up.
Brent crude, 88.90 so far this morning. Up next, we'll catch up with Frank Lee of HSBC, with Nvidia in talks to back an OpenAI data center. Plus, Yahara has your morning movers. Hyperscalers rising ahead of a massive week for mega-cap tech. Stocks up, crude down. This is the tape this morning. We're positive by 1% on the S&P 500. The story so far, the Nasdaq up by 1.6. Mega cap tech earnings just around the corner. 1/5 of the S&P 500, almost, across 4 names reporting Wednesday and Thursday. Epic. I love this week, together with the Fed decision in the mix as well. So that's the equity picture. Let's turn to the commodity story. Energy looks a little something like this. Brent and WTI getting hammered, down by 8%. 13 days of strikes. Turns into a 3-night break. We hit pause. Let's see what happens from here. But this is how the stage is set so far this morning. 83 on WTI. So you take a big move like that. Before today, we had a 30% plus rally. I think something like 33% higher on Brent for the month so far before these moves. And this is what you get back in the bond market. So yields were climbing, and now they dropped by 3 basis points. It's nothing, Bramo. 2s at 430, 10s north of 460.
There are other inflationary components that are going to be factoring to core PCE that we get later this week, and some of the data that we've gotten so far. We also have a whole host of issuance coming later today even. We've got $69 billion of 2-year notes. We've got $70 billion of 5-year notes. If yields go just a touch lower, just think about everything that's coming to meet that, and that's happening around the world. So this is a twofold story. On one hand, this is a Fed story, a Fed potentially ambiguous and potentially that's going to be live later this week. And we also have supply that continues to meet any kind of dip in yields with incredible bravado.
We've got a big competition for capital in global markets right now as we count you down to the open in about 3 hours away. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with Nvidia. Shares are up nearly 0.9% in the pre-market. Honor reporting that it is in talks to help back a massive AI data center project for OpenAI. The chipmaker could provide a financing guarantee of as much as $250 billion for the Ohio data center, and it just begins to also highlight the increasingly circular nature of the AI boom. And that makes today's move notable because investors have recently questioned how aggressively these hyperscalers and these chip makers have been spending on AI infrastructure, though we are seeing the broader tech trade move higher as well this morning. And that report is also helping the neo clouds this morning, like Nebius and CoreWeave, all up in the pre-market. And our analysts here at Bloomberg say that if Nvidia is willing to back financing for these massive AI infrastructure projects, it does help ease concerns that the financing for the next wave of data centers could dry up. And so that is a positive sign for these names. And we end on the broader tech trade, as I said, moving higher in the pre-market as oil plunges and ahead of earnings from the likes of Amazon, Meta, and Microsoft later this week, as investors come into these results with a very different mindset than they have ahead of other earnings. As Alphabet showed us, strong AI growth alone may not be enough if it's also accompanied by bigger capex and negative cash flow, especially as we see elevated yields as of late, just highlighting how much more expensive that AI build-out could get. John.
Yahara, thank you. That was what was so notable, I think, about Alphabet last week, that we were told last earnings season, sure, you can hike up capex so long as you put up the growth numbers, so long as the numbers elsewhere are decent enough. And Alphabet put up decent numbers, beat expectations for cloud revenue growth. What more do you want? I think that's up more than 80% in something like the last 12 months, which is crazy, given how high the base was to have that kind of growth coming off that. But to your point, you said it repeatedly last week, negative free cash flow, too much capex, markets started to push back. That's how high the bar is. What does perfect look like? I don't know. But we're going to find out later this week.
Or we're not, because ultimately nobody knows what's perfect, and that's the reason why you see the skepticism. There also is a question around accounting. The fact that a lot of people are watching the semiconductor manufacturers book the profits without necessarily the cost being put on the balance sheet of some of the hyperscalers yet until it's actually deployed. So there are all sorts of reasons why people are getting a little bit skittish about some of the volumes being mentioned.
On our raise out this morning, let's get to some top stories. The US pausing strikes against Iran for a 3rd night after 13 straight days of attacks. Iranian state media saying the country is halting its retaliations as a result. Elsewhere, a blockbuster week ahead for big tech earnings. Meta, Microsoft reporting after the bell on Wednesday. Apple and Amazon on Thursday. The 4 companies accounting for over 17% of the S&P 500. And finally, Chinese chipmaker CXMT surging more than 460% in its trading debut in Shanghai. The company posting the 2nd biggest IPO in China's history and becoming its largest onshore listed company as Beijing ramps up its push to secure AI independence.
It briefly surpassed Tencent, which is listed in Hong Kong as the most valuable company in China. This is a company that makes memory chips and actually makes most of its profits from selling lower-end chips, the DRAM, to consumer products companies. But they're benefiting from the increase in prices, and they are manufacturing some higher-tech memory chips. It highlights, the different fates for companies that are in different parts of the tech stack. Think about how different SpaceX IPO was versus this particular IPO. And it highlights how much people are chasing the next best thing. And ultimately, you're going to end up with more memory that gets produced to offset the shortage. So at what point does this suppress some of the costs?
I think it also highlights the fact that right now the United States has a moat around a lot of these memory chips and what is and is not export compliance. There's a lot of export controls on what China is actually able to get their hands on. So then you have this Chinese company with incredible amount of demand come to market. Well, that's why you see that insane percentage spike on the screen.
It shouldn't really work like that. That's called leaving money on the table, isn't it? Would you call that a good IPO? Like to have a move that large on the first day of trading?
I think good is an understatement. I think it also highlights how much the retail portion of the IPO was a big part of that. It was 212 times oversubscribed, the retail portion, just to give you a sense. I mean, that's nothing compared to what we saw with SpaceX, which was 10 times oversubscribed. So 212 times oversubscribed, 10 times oversubscribed. It gives you a sense of how much interest there was.
Some big numbers. Let's stick with tech. Nvidia ramping up investments in the AI ecosystem.
Open models are essential for innovation. It's necessary for sovereignty, company sovereignty. I see a future where the world uses tons of closed models. I encourage everybody, including my company, to use OpenAI and Claude and Cursor and Cognition and Perplexity. Use everything that you can because it's out of the cloud.
The company entering talks with OpenAI to help backstop the company's lease of a $500 billion US data center. Sources telling us here at Bloomberg the chipmaker may provide a guarantee of as much as $250 billion. Frank Lee of HSBC has a buy rating on Nvidia and a $325 price target. Frank joins us now for more. Frank, welcome to the program. You've heard the word that's doing the rounds this morning, literally, circular. Yeah. Frank, your response to that, how circular does this look? Is that a problem?
Yeah, I mean, I think this is not the first time we've seen it. But I think this is the first time we've seen the scale, right? I mean, Nvidia has started to do deals with the neoclouds earlier, and so this is the first time. It shouldn't be a surprise, but the magnitude and the location. I mean, this is the size in one place. We've seen Broadcom do a similar backstop deal with OpenAI and Anthropic as well. So I think it's becoming more and more the norm, especially as people have questions about, the free cash flow and the sustainability of funding the overall AI capex.
Frank, to that point, does that reveal just a little bit of weakness, some vulnerability in the AI ecosystem that Nvidia even needs to do this?
Yeah, I think what you're seeing is that you are starting to see questions being asked. So just putting up a capex number like we've seen that has worked before in the past is not working in this market. Now, what is positive, though, is that if you look at, even though Alphabet has turned free cash flow negative, the leverage and the debt for most of these hyperscalers are still relatively small. So I think you could see collectively the group able to fund somewhere about over $1 trillion next year and even more in 28, even if it means raising their debt to equity.
Frank, why is Nvidia backing OpenAI's effort to secure this compute? Evidently, it was reported that several other big companies were interested in leasing this particular data center compute capacity, including Google, including Amazon. Why OpenAI and Nvidia?
Well, I think if you look at, OpenAI has needed more, I think, help on funding. And you've seen that over the last 6 to 9 months. They've done other deals. And I think, in the case of NVIDIA, they need to make sure that the momentum of OpenAI stays there. I think you're seeing they've already started to commit to to neoclouds, but OpenAI is such a big benchmark and such a big representative of the overall AI trade that I think they need to make sure that they can keep this going. So I think that's why it makes sense for them to backstop pretty much a large company like OpenAI.
Is there any political aspect to this, Frank, considering that this particular data center is being fueled by a Japanese investment in the U.S.? It was much heralded. It's on national-owned land in the United States, in Ohio, and comes with SoftBank's backing. So it's NVIDIA, SoftBank, the U.S. government. And can you sort of draw a line through this triangle and give us an understanding of what the backstory is?
Yeah, I think if you look at it, it seems to hit a lot of, or at least check a lot of a lot of benchmarks, right? You have politically Japanese sort of related investment now in the U.S. It's being put in Ohio and I think in the heartland of the U.S. And so I think it hits a lot of these check marks in terms of where the investment in the data center is collectively from many different parties and including more international flavor. So it just shows you, I think, the investment in the States is real, right? And it's a very large project.
Frank, are you surprised that the stock's not up more?
Well, I think, the thing is, it goes back to the fact that they have to put up this money. So how much does it drive the overall earnings upside from what's already in the, in people's expectations? That's still a big question mark. I think what this does solve is that, okay, funding problems, concerns, that seems to have gone away for the time being. And so I think that at least stems kind of the concerns that people have about keeping the AI trade alive. But how much does it add to Nvidia's earnings? I think it's still very unclear right now, like how much incremental is it going to bring to revenues.
We were just talking about China's largest memory chip maker, CXMT, and the insane IPO it just had. What's your reaction to that?
Well, I think, because if you think about the memory trade, it's been one of the best spots to be in tech in the last 6 months. A lot of memory names have gone up almost, 5 to 10x, right? But China hasn't really had a company that has been in memory. And so this is the best way, I think, for investors in China to participate in the memory trade, right? And so I can see why the interest is so strong, because globally people have been able to invest in memory companies all over the world, but we haven't had one in China. Now the question is going to be, though, is are we near the peak of it? Because as you've seen some of the memory stocks outside of China, they've started seeing a pretty hard correction recently because of these long-term agreements. So what the question is, will we see perhaps this fade at some point in the China market after a strong day like this?
Frank, good to see you, buddy. Thank you. Frank Lee of HSBC. Strong kind of understates the move. There wasn't a typo, by the way. 465% plus for that particular name.
Yeah, and it does highlight how people want to get exposure to Chinese-specific technology. But the idea that it's the peak, or it marks the peak, or souring in stocks from SK Hynix to Samsung, highlights they could produce more. And what does that mean? It lowers the price and potentially the profit margin.
There's some of the tech stories so far this morning. The broader market doing better than good, bouncing back by 1% on the S&P 500. With an update on stories worldwide with your Bloomberg brief, Vonnie has more. Hey, Vonnie.
Hey, John, thank you. In Europe, French and Spanish firefighters are battling wildfires for a sixth day. More than 300,000 people have been evacuated as the fires threaten cities including Madrid and Bordeaux. Temperatures are rising this week, and officials are saying the fires are creating their own microclimates. Israeli Prime Minister Benjamin Netanyahu is planning to meet with President Donald Trump at the White House tomorrow. Netanyahu is expected to push the president to keep a constant watch on Iran's nuclear program. Oil sinking as the U.S. pauses daily strikes against Iran. Brent tumbling below $90 a barrel. WTI and European natural gas also falling. And that is your Bloomberg brief. John.
Vonnie, thanks for the update. Appreciate it. Up next on the programme, gearing up for a live meeting.
Every meeting is a live meeting depending on what needs to be done. But I don't expect that they will make a change. I do think there's not a small chance there could be dissents. We have heard some vocal people that are in favor of raising rates.
A two-day family fight. Exciting stuff down in Washington, D.C. Blake Gwinn of RBC joins us next, live from New York. You're watching Bloomberg Surveillance. It's the bounce in equities this morning. We're 1% higher on the S&P 500. At the index level, the losses last week weren't great. We were down by 0.66%, I think, on the week on the S&P 500, which is not a major week of losses for the S&P. Within the index, there were some much bigger losses. Say Alphabet down 8% last week following earnings. Tesla down by 18% last week following earnings. Not great. The big spenders were punished. Increased capex at the likes of Tesla, the likes of Alphabet. But the guys who received the money weren't exactly rewarded. I think semis were up on the week by something like 1%. And Intel, it's like the banner, the headline for that sector right now, put up some great numbers and that stock was down in Friday's session into the weekend.
It has raised the question, how high is the bar? It also raises the question about whether we're on the brink of a sea change, a rationalization in some of the spending. And we hear about it from corporate executives, about the token maxing turning to token rationalization, this idea suddenly people don't want to spend on this exact product. And if they do, they want to see the cheapest potential version that they can get. This, with a backdrop of an endless, insatiable appetite for capital, gives people a little bit of agita.
Setting the tone for this market this morning, this move in crude unwinding some of the gain of last week. Last week up 10%, the week before up 15% plus. This morning down 8. Let's call it 90 on Brent. Still a problem from many a policymaker out there. WTI around 83, including the Federal Reserve. So even with that move, you don't get a big turnaround in yields. And we saw this earlier this year. You had the big round trip on oil a few months ago, and yields didn't really retrace the move higher of the last 5 months, and they hold 430. We're down by 2 or 3 basis points. So let's just sit at the front end of the curve. I think that's a story not just for the US, it's a story for Europe and the ECB as well. One ECB official came out this week, just in the last 24 hours, and said that even with this story in crude, you still might have to hike interest rates one more time by the ECB.
Yeah, I mean, look, the ECB has another potential issue because it's the distillates, and that has a longer kind of runway than just the actual crude prices. But what this highlights is that crude traders can trade on a dime, policymakers can't. So how do they come up with some sort of longer-term forecast, given the fact that this conflict still hasn't ended?
Oil volatility is also inflationary. That is the title of Bank of America Global Research this morning. And they're saying that it's not just the level. Oil volatility can be inflationary. Some prices go up with oil, but are reluctant to come back down. And that's the problem the Fed, the ECB, they're all going to have to deal with.
The Fed's two-day meeting starts tomorrow. Under surveillance this morning, gearing up for a live meeting.
Every meeting is a live meeting, depending on what needs to be done. But I don't expect that they will make a change. I do think there's not a small chance there could be dissents. We have heard some vocal people that are in favor of raising rates. I don't think that there's necessarily the group yet that's ready to make that change.
So here's the latest this morning. The Federal Reserve preparing for a family fight ahead of the latest interest rate decision due on Wednesday. Blake Gwinn of RBC writing, July is only mostly dead, and there is a big difference between mostly dead and all dead. While we ultimately expect the Fed to deliver a hawkish hold, the door to a hike is still ajar. Blake joins us now for more. Blake, good morning. Enjoy the note. Mostly dead, not all dead. What's the difference between the two right now?
Well, that was a Princess Bride reference. I hope that didn't go without mentioning. I at least need to bring that up. I think this is the first time I can really remember going into a meeting with this much uncertainty. It just wasn't really in the nature of previous Feds, to go into a meeting and do something that wasn't pretty much priced into the blackout. So this really is a live meeting. I think it's tough to tell what they're going to do. I think they ultimately hold. But the risk that we do get a surprise is much, much higher, I think.
Is that by design?
Possibly, and I think that's what we don't know. I mean, we don't know how Wolfe is going to run these things. I think he probably has a much higher comfort level surprising markets, just given some of his comments around not wanting to provide forward guidance. He has talked positively about this idea of surprising markets. Now, I don't think all of the committee members share that. We've heard from others that say, there's no real benefit to surprising markets. But I think Wolfe may feel that way, that they don't want to telegraph these moves. So maybe we are in a new period where these blackout periods are going into meetings. We are going to be more back and forth rather than kind of locked into a decision, 2 weeks ahead of time.
How long can he keep this uncertainty before he has to make a move?
That's a very good question. I think he's been very steadfast in not providing forward guidance. It's just that umbrella of what he considers forward guidance seems to be extremely large. I think of forward guidance much more like an I will statement. He seems to include if-then statements. We've heard those if-then statements, the kind of framework guidance, if you want to call it that. We've seen that from Waller and others who, coming into this meeting, he gave a very clear if-then statement. If we get a hot CPI, then we'll have to think about near-term hikes. Wolfe so far has held off on that. I don't know if that's a long-term thing, or he is going to feel the need to start providing a little bit more once he gets his, kind of feet on the ground.
Right now, people seem to be pricing in something like a 30%, 35% chance of a Fed rate hike, pricing in almost a complete rate hike by September. Will they start to price out rate hikes if there is no move, right? I mean, how long can hawkish jawboning actually do the trick of introducing uncertainty if there isn't a move, even on some pretty aggressive rhetoric?
I think they can hold on to it for a while, to be honest. We have a call for the Fed to remain on hold for the rest of this year. That is very much conditional on seeing continued improvement in the labor markets, but more importantly, the inflation markets. So that's kind of our view. But I do think even if they do hold as we're expecting, the market can maintain this kind of upward slope of Fed pricing. We just keep pushing it out. We've seen the same thing with cuts where the Fed was kind of on hold and the market would just continually price cuts into the curve and just keep rolling that forward and rolling that forward.
Do you think it's significant that he's holding a press conference? He said in the past that he'd only hold a press conference if he had something to say. Does he have something to say?
Yeah, I think markets made a little bit too much of those comments. Maybe that's something that comes out of the task force. I don't think they're making any changes for right now. I do think logistically it gets a little weird because now you have all this signal attached to whether or not you have a press conference. If he calls the press down to DC and says you all need to be ready, there's going to be all kinds of chatter about what are they announcing? Something big's happening because they called a press conference. So I think if it's ad hoc, you run into this problem of the signaling that's now attached to whether or not you're having or planning a press conference. So if they do decrease the frequency, I think it's much better to do something that's set on paper, like we're going to do go back to every other meeting or something like that, if they want to reduce the number. But this idea of ad hoc gets a little weird, and I think you add too much signaling value to whether or not we're having one.
Do you think he's going to have to defend the decision if there is dissenters?
I don't know that he really has to defend it. I think, if anything, what we've seen from him, with the hawkish dots is, I think he kind of likes having something to push the hawkishness off onto. If we do think he's still, in his first couple of meetings, does not want to see a lot of pressure from the White House for coming out, supporting hikes, or getting more hawkish. A very easy way to do that is kind of say, well, this is a committee decision. We've got these people that are hawkish over here. We kind of did that with the dots in some ways. I mean, he came out, he said, oh, I didn't submit a dot. We have very hawkish dots, but I didn't submit one. So in the same way, you have these dissenters who are kind of saying we'd rather hike. It gives you a nice kind of deflection there, I think.
Do you see a path for lower yields?
It's very, very difficult. I could think of probably 8, 9 credible stories for yields to move higher. It's very difficult to find more than 1 or 2, and most of those run through some kind of major equity correction or, actually heading into some type of recession.
You need some risk aversion or a growth scare.
Yeah, and that just seems very unlikely right now.
A decline in crude doesn't get it done.
You guys were saying in the lead-in here, you've got this kind of ratchet up, but then it doesn't really follow down. And even the last 2 weeks, as we've seen this re-escalation in Iran, yields have been trading almost in lockstep with oil. If you put those two charts on top of each other, they look almost identical. So they move up, but then when we see oil go back down, we don't really rally in yields.
They stay higher. Blake, thank you. Appreciate it. That's been the dynamic over the last 5 months. Blake Gwinn there of RBC. Far more sensitive to crude when crude rallies than when crude declines.
Yeah, and partly conditioned by experience. Look at what inflation has been doing. The fact that it was supposed to be decelerating. We were supposed to be getting back to 2%. And we saw a re-acceleration this year that makes people queasy when they've been saying that they are absolutely tied to the 2% target. And they haven't reached it for more than 5 years.
Yields this morning down 2 basis points, twos around 4.30. Looking for a few dissents later this week, potentially. To Blake's point, maybe that does the Fed chair a bit of a favour under pressure from this administration.
Because imagine he's in a situation where he has to hike rates before the midterm election. He could say, well, I put off those hawks and those dissenters for months. I had no choice, but the committee was moving in this direction. I tried as best as I could. So it really just gives him a little bit of cover, potentially.
The press conference thing has become ridiculous, hasn't it? You go to a quarterly cadence, you go back to where we were before. They'll only hike if it's at a press conference meeting with forecasts.
But then if they want to hike, they can't hike at a regular meeting. I mean, either way, just have a press conference every time.
Up next, Lisa Shalett of Morgan Stanley, Tobin Marcus of Wolfe Research, Amanda Lynam of Goldman, and Krishna Guha of Evercore. Or just don't have any news conferences at all. Just put it all back in a bottle.
Yeah, and then just
bury
have
it.
Other people talking. Shut it down, Jonathan Ferro.
The economy continues to prove resilient.
I'm not sure a rate hike is the solution.
A bet on no cuts for this year is really a bet that you get continued weakness in inflation.
I still think it will come down to the data.
The market's not ruling out July, and honestly, neither are we.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. And your price action, your scores look like this. Here's the bounce from back-to-back weekly losses. The S&P up by 1%, the Nasdaq up by 1.6. In the bond market, small decline for yields, 2s out to 30s, 2s and 10s down 2 to 3 basis points, 2s around 4.30, even with a move this large in crude. WTI and Brent down across the board. We're negative by close to 8%. Brent crude around 89, just south of 90 heading into this week. Right here, front and center, a Federal Reserve decision 2 days away, and then this lineup for big tech: Microsoft, Meta, Apple, and Amazon.
So you asked us to rank this in terms of whether you thought that the Fed or tech earnings were going to be more important, and I would say they speak to each other, because ultimately the Fed has to consider whether AI is inflationary or eventually disinflationary, and how much capital markets are fomenting some of the inflation that we're seeing in the system that really goes outside of just the oil prices. This is a difficult conundrum to really unpack, especially because the market is kind of queasy about all the capital that they're raising and how expensive this is going to be. So whether the Fed leads or whether tech leads, we're going to get a whole host of information this week that potentially could color the remainder of this year.
And it's really hard at the moment when you have last week us talking about triple-digit crude and this week talking about Brent oil below $90 a barrel because the United States is on pause. But how quickly can that narrative shift? And to Bank of America's point, oil volatility is inflationary. If already products that oil bleeds into is going up because the oil price is going back and forth like a yo-yo, well, that product price is not going to come down nearly as fast, and that is what the ECB and the Fed are going to be dealing with.
It's worth pointing out, as you have done several times, we've now got 2 choke points, not 1. Plus, the cushion's getting smaller, and this move in crude this morning, it's unwinding some of that move. Very close to 90 still on Brent, which speaks to the limited price action in the bond market. Blake Gwinn of RBC was with us just moments ago. You'll see yields move tick for tick with the price of crude intraday when crude is moving higher, but on the way back down, the bond market will just ignore it. And earlier this year was a perfect example of that.
Right now, you're seeing other inflationary pressures. You're also seeing, to your point, both of you that are making distillates take a lot longer for prices to come down. I'm looking at diesel. The average diesel price in the U.S. still at the highest level going back to mid-June at $5.30. So you start looking at this, those still are going to be inflationary inputs down the line.
There's other fronts to watch as well, not just the 2 choke points when it comes to the Bab el-Mandeb Strait and the Strait of Hormuz. The fact that Iran is going after vessels in the Caspian Sea, and also China's crude imports this month are expected to edge higher. China has been putting a lid on how high prices can go because their imports have dropped. Well, now they're starting up again.
So what's the path to lower yields? Got a big competition for capital. Lisa's talking about it. Lots of debt being issued, lots of equity being issued as well. We've got lots of spending that's pushing up prices too. And you've got a market that's still 2 to 3% away from all-time highs. What is the path to lower yields here? Blake Gwinn, RBC, once again. 2 reasons you can get lower yields. I can only think of 2. His words, basically. 1, some risk aversion in markets, or 2, you start to price in a growth scare, and we don't see either right now.
And those 2 are connected because the wealth effect has helped really fuel a lot of the momentum that we've seen in the U.S. economy. Neither of these things are things that people want to see, nor are things that people have priced in, because there is one of the lowest probabilities of recession priced into this market in many, many years.
That Fed meeting, that decision, 2 days away. Coming up this hour, we'll catch up with Shalett of Morgan Stanley ahead of a blockbuster week for big tech. Tobin Marcus of Wolfe Research with crude easing as the US and Iran pause hostilities. And Krishna Guha of Evercore expecting Kevin Walsh and the Fed to stay on hold. We begin this hour with stocks rallying to kick off a crucial week for Wall Street. Shalett of Morgan Stanley writing, "Now is the time for risk management and patience, not greed. 8,300 remains our target in the year ahead, but the ride currently looks like a bumpy one." Lisa joins us now for more. Lisa, welcome to the program. I want to give you a shout out. Your words on chips, I think, were really important in the past few weeks. We saw some big companies come out with some big spending and chips didn't rally big time at all. In fact, Intel sold off into the weekend, even on great numbers. Lisa, what is that validating for you?
Well, when the market stops rewarding good news, you have to pay attention because it signals that the narrative is changing. And right now for us, we're focused on this idea that more is no longer more. More CapEx spending actually is starting to worry the markets about when I get a return on investment and if we're going to get to a place of, in fact, overspending.
What position does that leave the likes of Meta, the likes of Microsoft, the likes of Amazon in this week?
It's very, very, very tough. I mean, I think that these guys have to be extraordinarily clear in articulating their forward guidance, in articulating their forward strategy, and beginning to articulate those paths to monetization. Obviously, our best guess is that the numbers for the current quarter are going to be exceedingly good. We know that, one of the hyperscaler compatriots, Alphabet, Google, reported last week, and you saw what the market did when, Google talked about, even yet higher spending. So I think that they need to be measured. They need to be precise in this guidance and what the incremental spend on CapEx is going to go towards and when folks can expect some positive return on that investment.
Lisa, you said it really well. This idea that when stocks don't perform as you'd expect, that signals a narrative shift when you see stocks selling off in the face of good news. I wonder if you expect capital markets to start to materially push back on some of these companies. We're seeing it in the equity prices, but we're still seeing the big hyperscalers and others be able to raise huge amounts of money in debt and equity markets. Do you think that anything could change that in the next couple of months?
I don't know that it's going to change in the next couple of months, but we are seeing, the market start to vote with its feet. We just talked about the stock prices. Another thing to talk about is some of the spread widening that we've seen in some of the investment grade debt issuance in the space. I know that for a long time, Oracle's CDS spreads have been a indicator on everyone's screen, on everyone's Bloomberg screen, the first thing that they look at in the morning. And so, I do think that the market is going to start to vote here about excess, about negative free cash flow, and about anxiety around the different paths to monetization.
There's a question people keep asking, where do you hide in this time of volatility? Is it the bond market? Well, bond markets have also been somewhat volatile, especially on the long end of the yield curve. Is it in sectors that could potentially benefit from some of the AI adoption and the efficiencies that could come to fruition? How do you see the landscape?
Yeah, so our strategy in this latest bout of volatility has been very much to play defense and play the AI beneficiary story. So we are moving into some of the energy names, some of the utility names. We've used REITs. Healthcare has been an interesting place to hide out, and we've even nibbled at consumer staples. So doing a little bit more rebalancing inside the portfolio, taking profits from some of the areas like semiconductors and reallocating and balancing the more defensive, income-oriented parts of our equity portfolios.
Talking about that volatility, in your latest note, you say, as we were going to print, Brent is back to $99 a barrel. Well, this morning we're below 90. I think the oil market has been humbling when it comes to how to deal with it on Wall Street. What are you telling investors? How do you think about this? Because it's incredibly difficult to predict, because the president one day is forecasting intensive strikes and then the next day pulling back.
Yeah, well, I think you said it best, right? Which is we have to observe that we don't know the answer on oil prices on any given day, but we do know that it is producing extraordinary volatility in the bond market, where the MOVE index is at a 2-month high. And what that tells us is that we're going to get a reset in some of the term premium in the curve, which means that those longer duration bonds are probably going to hang up there. Jonathan noted that some of this correlation between bond yields and oil has kind of not been symmetric, meaning the bonds are happy to go up with the price of oil, but they're not coming down with the price of oil. And I think that that's a market that is voting that structurally there is a higher bias around oil prices and this geopolitical uncertainty.
So in this moment, how hard is it for officials around the world, central bank officials, to look through the oil price shock?
I think it's impossible. I think that understanding when these hostilities end, how we're going to continue to cushion the blow of these constrained supplies. We've noted before that, the strategic petroleum reserves during the first 3 months of this conflict were extraordinarily helpful. The reduction in China's imports, extraordinarily helpful. But those drawdowns in inventories cannot last forever. And at some point, demand is going to come back into this market, whether the supply is there or not.
Lisa, it's good to see you. Really thoughtful stuff over the last month. Thank you. Been tracking your note every week. Lisa Shalett there of Morgan Stanley with the latest. You have to take note, take away from that conversation when parts of this market stop rewarding good news.
And we can see that right now, that is exactly what's happening. As Lisa said, it's not just the equity market, it's in the bond market as well, where you have the spreads on longer-term investment grade hyperscaler debt actually widening to levels that are akin to where junk bonds are trading. So there is definitely pushback. Whether it actually hampers their ambitions to keep building out some of this tech capacity, unclear.
I can think of one of those issues that might have been labelled junk to begin with anyway, but was labelled IG.
Which one? Oracle?
I think you all know.
Which one?
Which one that might be. They had a big IPO.
SpaceX?
Right.
I mean, all of them are widening, but yeah, this is the whole idea of,
it was issued as IG and started trading as something else.
Well, it was 40-year Mars debt.
Wider than its BBB rated peers, let's put it that way.
I mean, look, there clearly has been a re-rating in the debt market. How much this has to do with just duration, because it has been disproportionately longer term bonds. How much this has to do with true pushback. It's a little bit of both.
High yield spreads a little wider over the last 2 weeks. Still sub 300 basis points, I think, in spread, Bramo, but moving in the wrong direction.
Just slightly, starting to give a little bit of pushback to what we've seen over the past couple of weeks, but not as exactly pricing in screaming recession, still incredibly tight levels.
Amanda Lynam of Goldman with us in about 18 minutes' time. Look out for that conversation in just a moment. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The U.S. is pressing Mexico to align its tariffs on Chinese steel and aluminum with Washington's tougher measures. Sources telling us here at Bloomberg that Mexico is receptive to the proposal being discussed as part of the broader USMCA negotiations. CME is launching single stock futures today, allowing traders to hedge or speculate on more than 50 of the largest U.S. companies. The contracts will be cash settled on the closing price of the stocks they're tied to. Trading will be open 23 hours a day, 5 days a week. Nvidia CEO Jensen Huang says China has a leg up on the U.S. when it comes to AI.
My expectation is that China and the United States will continue to advance AI. In the case of China, they're producing more AI researchers than probably all of the world has, in any given year. And so they're producing, if manufacturing intelligence is important, they manufacture the most important version of it, which is the researchers.
Huang also telling our Ed Ludlow that this is the golden age for Korea. And that is your Bloomberg brief. John.
Vonnie, thank you. More from Vonnie in about 30 minutes. Up next on the programme, hostilities on hold.
We're locked and loaded and ready to go, but we're talking to them, so I think while we're talking, we'll see what comes of it. Despite what everyone says about the election, I'm not in a hurry.
Up next, we'll catch up with Tobin Marcus of Wolfe Research, live from New York City this morning. Good morning. Back-to-back weekly losses on the S&P 500 for the first time since March. This morning, your bounce. We're up by 1% on the S&P. On the Nasdaq, up by 1.5. On the Russell, up by 1.2. It is the everything rally. The bond market rallying too. Yields are lower across the curve, but only by a few basis points. 2s, 10s and 30s down by something like 2 basis points at the front end of the curve. That tells you a lot about expectations this week, I think, and beyond this week, that there is some two-way risk for this Federal Reserve through the summer, even with this moving crude. WTI and Brent this morning down by 7, 8%, whatever it is right now. Brent crude at 89, call it 90. That move alone does not shape the story at the Federal Reserve. So much more is happening with financial markets and the global economy.
People have been really surprised by the fact that even as crude prices went up significantly so far this year, you've seen a reacceleration in the labor market. So that's taken the concern about the labor market off the table for the Federal Reserve. And as you get more oil price volatility, it has incurred a significant tailwind to inflationary pressures. That puts the Fed in the hot seat, regardless of the near-term price action in oil from day to day.
Crude this morning down on Brent and WTI. That Fed meeting starts tomorrow, concludes on Wednesday. Overwhelmingly, the consensus is no change. But there is just a small amount of two-way risk introduced by design, I think, from a new Fed chair that is open to this, just killing the hand-holding of the post-GFC era?
He's been quiet. A lot of people have been very vocal, and the Lori Logans and Beth Hammocks of the world are saying we have a clear problem with inflation and we need to do something. So clearly they've introduced two-way risk, and he has introduced the other-way risk by just simply remaining mum.
Wednesday, 2 p.m., when we get that statement, go to the bottom of the statement. I think we're all expecting to see some dissent if they keep interest rates unchanged. Under surveillance this morning, hostilities on hold.
Look, we're talking to them right now. I think they're getting more and more serious as the days go by, for maybe the obvious reason. We're locked and loaded and ready to go, but we're talking to them, so I think while we're talking, we'll see what comes of it. Despite what everyone says about the election, I'm not in a hurry.
So here's the latest this morning. The US and Iran pausing strikes for a third straight night. The Trump administration denying reports the break in attacks is due to falling stockpiles of air defense missiles.
That's right. When it comes to what's going on, when it comes to Iran, we have seen this before. The president has taken pauses, but we've seen actual diplomatic discussions. Right now, the reporting is really lending hand to the fact that we've just have depleted too many of our munitions, and they're concerned, especially when it comes to the Patriot missile system. At the same time, we also have the fact that this president potentially is a little bit nervous, as well as where oil prices were. Near $100 a barrel is when we decided to take this tactical pause. So there's a lot of potential issues going into this decision. But one thing is for sure, there is still a conflict right now when it comes to the Strait of Hormuz in the Middle East. No vessels are getting through the Strait of Hormuz. And the discussions Iran is having right now, they say with Oman, is just about control of the waterway.
So which one is it right now? You've got markets, you've got midterms. I think they're one and two are the same thing right now. One informs the other to some extent. And then you've got stockpiles. And stockpiles have lingered as a reason, an issue shaping how we approach this particular conflict. It's lingered for the last 5 months.
And it's not exactly a question of whether they have enough munitions to actually keep going. There was a Wall Street Journal article that I thought was really telling about General Dan Kane, going to the White House and saying, look, longer term, there are low inventories, in particular of air defense interceptors, and that longer term, this could present a problem for the United States, and even in the medium term, should there be a conflagration in the region or anywhere else. At a certain point, that is a risk that is weighing on the side of maybe not taking action, especially if there isn't a clear outcome that can be accomplished.
Tobin Marcus of Wolfe Research writing the following. He says a durable diplomatic off-ramp is even harder to envision this time. We wouldn't fault anyone who prefers to tune this all out. They're not alone. But we do suspect it'll get worse before it gets better. They're not alone, is my words, not Tobin's, though I'm sure he agrees. Tobin, welcome to the programme. It's important for us in financial markets to try and get an understanding of what this president is sensitive to and what might shape outcomes in the Middle East. This is the reporting from the New York Times. Among the worries is that expanded hostilities could dangerously drain the diminished stockpile of air defence munitions in the Middle East. Tobin, how much weight should we put on that reporting over the weekend?
I think it's a very significant consideration, and one that we've been talking about since May, if not before, as a factor that could cause a de-escalation. In mid-May, before we got what I think was the sort of final turn towards the negotiation of the MOU, we were flagging both spiking bond yields, which then topped out around 4.67 on the 10-year, levels that we've breached and are still near even after the rally yesterday, and the depleting stockpile of air defense munitions as two things that could essentially force some kind of a durable diplomatic turn, a de-escalation, a deal. And I think those two factors are still very, very live and are driving a lot of what we saw at the end of last week.
But alive for how long, Tobin, until the president decides that it's time to escalate? Or do you actually see a diplomatic off-ramp at this moment?
Well, yeah, it's easy to just stop shooting, which is what both sides have done for now. I think, Iran tellingly is saying they're going to stop strikes on U.S. bases as long as the U.S. strikes stop. But I don't see any indication that they're going to stop strikes on ships if necessary to try and, force them to accept their leadership in the Strait. So, we already saw the best attempt to finesse the differences between the U.S. and Iran on control of the Strait of Hormuz in the MOU, and it immediately fell apart. So it is challenging for me to see what a permanent solution could look like unless the U.S. just becomes willing to accept Iran's assertion of control over the Strait. And thus far, we really have not been doing that.
There's other reports out, especially about late Senator Lindsey Graham, and this footage that's now starting to come out from a documentary he was filming. And he allegedly told Jake Sullivan that he did not believe Trump's envoys, Jared Kushner and Steve Witkoff, could manage the negotiations because of what he considered conflict of interest. Do we have the right personnel at the table?
Well, it's been a very kind of multifactorial process all through the diplomatic track. We have these multiple third countries mediating. The messages coming into the White House seem to be going not just through Witkoff and Kushner, but also through Rubio, through Vance, who's been, very frontally involved at various stages. So I don't really see any of the diplomatic challenges as being, just down to the composition of the negotiating team. I think basically the challenge is how far apart the two sides are substantively and whether or not they can come together absent more pain for one side or the other.
Tobin, this administration has seen a real loss in popularity as a result of the Iran war. At the same time, Democrats don't have a significant popularity when it comes to the view of how they would handle the situation of Iran. What is the Democratic proposal on how to extract the United States and create some sort of status quo in the region?
Oh, I certainly would not say that there is a kind of a cohesive Democratic strategy. At this point, I think the position from most Democratic leaders is the problem is that we're in this situation already. We starting this war was the mistake. At this point, there's no kind of clean or easy way out of it, which I think is true. If they have the luxury as the opposition party of just being able to point to the president and say, look at how badly he's managing this conflict. And I think that message is working just fine with voters. But, if, God forbid, we're still in the middle of this, 2.5 years from now, and a Democratic president comes in and has to try and uncrack the egg, I think that'll be really challenging.
How does this really factor into congressional support for increases in budgets, for creating some sort of backstop to support the military? I mean, this really raises some real questions operationally. It's one thing, and this happens every single cycle, whether it's Republicans or Democrats. If they don't like the policy, they won't vote for it. But at a certain point, how do you end up with some sort of cohesive policy that can gracefully extract the United States while also having the resources to restock the ammunition stockpiles?
Yeah, on the defense funding front, I think we're in for a relatively unexciting outcome. I mean, we've seen these very large numbers thrown around, the president proposing a total budget of $1.5 trillion. We're not going to come anywhere close to that. I think the base defense budget, we're going to get a basically status quo outcome, kind of low single-digit growth that's out of the bipartisan negotiations. It'll eventually kind of pick up in the Senate. Then they're using reconciliation to get through a really quite modest slug of money in the $60-65 billion range. And I think that's all that they're going to get. I don't think that they're also going to get a bipartisan supplemental in addition to that reconciliation bill. I don't think they have the votes to move a bigger number through reconciliation. So, we can all see the problem now in terms of the defense industrial base, the adequacy of our munition stockpiles. But getting the funding to really structurally change that, I think will be very challenging.
Bowls of cereal just been thrown across trading floors the world over when Tobin Marcus said if we're talking about this in 2.5 years. Can you imagine? 2.5 years still talking about this?
I don't think anyone wants to imagine that, but I think
JCPOA took 20 months to
negotiate. Nobody wants to be doing this in 2.5 years.
No, I know, but we didn't talk about it because it wasn't causing the price of oil to really shift around.
But we can be living in this status quo for a very long time.
Can we shut that down too?
Shut it down.
Shut it down.
Should I just call you Gordon?
Tobin, appreciate it. Thank you, sir. Kinda. Tobin Marcus there, Wolfe Research. 2.5 years of covering this.
John Ramsey.
For those of you that don't know, fantastic program with Gordon Ramsay. Right? They might not know what we're talking about, Brahma.
Thank you. Shut
it down. Equities bouncing back up by 0.9% on the S&P following the first back-to-back weekly loss on the S&P 500 since March. It's worth pointing out we have had a tech scare. We have not had a growth scare. If you strip down the big muscle of tech and look at the equal weight was up just about last week. If you look at the individual sectors, bank stocks don't rally for 8 consecutive weeks. We're going through a rough patch in the economy right now, so clearly we're not. Based on financial market pricing of that rough patch, there is no growth scare right now. And the bond market speaks to the same thing. 2s, 10s and 30s. Yes, we've had a rate shock, if you can call it that. In the last 5 months, we've had a push higher on 2-year yields up to 4.30, comfortably above the policy rate of the Federal Reserve. But we've not had a growth scare. We've had an energy scare as well, but we've not had a growth scare. Crude this morning, Brent and WTI down by 7 to 8% this morning, 89 on Brent. And these are the shocks we're working through, Bramo, the rolling shocks. You've had them in energy, lots of volatility. You've had them in the bond market. You've not had them in the outlook for growth just yet.
Part of it is because capital expenditures have just absolutely flooded this market with cash. And even if it isn't coming right now, at least in terms of stock price performance from the hyperscalers, you are seeing the efficiencies come from the deployers of AI. I keep going back to this Mike Wilson note. He said that he expects about 100 basis points of net margin expansion through 2027 as a result of adopting some of these AI technologies. So he's talking about software areas that have been left for dead, or banks or other companies. Are they willing to pay for it, though, at the levels that some of these hyperscalers are borrowing? And that anxiety you can see clearly under the surface.
They're issuing so much debt. We start this week, every single quarter. It's my favorite week. I know it is for many of you, too. You get all these tech earnings. You get the Federal Reserve decisions. Sometimes you get a payrolls report in the mix as well. If things are really special, they're not this week. And we often ask, what's the most important event? Is it the earnings? Is it tech? Is it the data? I asked that question earlier this morning. I give credit to you for last week for pointing out the following. For the bond market, you might be able to make the argument that the tech results are just as important to the bond market, maybe more so, than the Federal Reserve.
I mean, right now, I'm looking at issuance so far this week. Just government issuance. $69 billion of 2-year notes and $70 billion of 5-year notes today. Tomorrow we get 7-year notes, $44 billion. And then you have to imagine that Alphabet and Meta and Microsoft and all of the other hyperscalers are going to come out after announcing their incredible plans for expansion and capital investment. And they're going to say, OK, we need to sell debt because we need to raise more money. So who's crowding out who? And how do you establish interest rates at a time where everybody has their hand out? And investors have the privilege of being able to say, we want more money if we're going to give you our cash.
Amanda Lynam of Goldman Sachs standing by to answer some of the questions on that issue in just a moment. As we count you down to the opening bell, 2 hours away, let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Well, ahead of those big tech earnings that you are talking about, we are seeing the entire AI tech trade moving higher this morning. And we start with the neo clouds. Nebius and CoreWeave are both higher. And it is on the back of this Nvidia story. We're reporting that it's in talks to provide a $250 billion financing guarantee for an OpenAI data center in Ohio. But the bigger picture, what analysts are saying is that the move reinforces confidence in both demand for compute capacity and that the funding needed for the next wave of AI projects is there and moving forward. We are also seeing the chip stocks rebounding after last week's brutal sell-off with names like Intel and AMD up in the pre-market. Yes, helping this is easing tensions in the war with Iran. But the real catalyst will, of course, come later this week when the hyperscalers report. If Amazon, Meta, and Microsoft raise their CapEx spending, it will only reinforce this idea that demand for semis is still going strong. And we are also seeing Rocket Lab surging this morning, up nearly 5% on this news that the company won its largest ever launch contract, a $266 million deal with the U.S. Space Force. The contract includes 12 launches for the potential for 6 more. John?
Yahara, thank you. Thanks for the update. On our radar this morning, what about top stories? Crude prices easing as the U.S. and Iran pause attacks for a third straight day. Washington's ambassador to the UN saying President Donald Trump is giving diplomacy, quote, some space after threatening to ramp up attacks. Elsewhere, the president heading to Michigan to visit testing grounds for General Motors and deliver remarks on the economy later on today. It comes as early voting for the August primary in the state gets underway. And finally, Nvidia is in talks to back OpenAI with a financing guarantee of up to $250 billion. The deal would help the ChatGPT creator lease a massive data center in Ohio and adds to skepticism over circular financing fueling the AI boom.
So there are a lot of questions, more questions, I would say, than answers in this reporting. First of all, what does it mean to have a $250 billion backstop for OpenAI? It's not necessarily an investment. This comes after, remember, in September of last year when they had that $100 billion rolling commitment, letter of commitment to Nvidia. To OpenAI. Nvidia also has a $30 billion equity stake in OpenAI. And you take a step back and you wonder why OpenAI. A lot of different companies want to have compute power and want to have a lease with this particular data compute center. You start to wonder, is it too big to fail? Is it getting to the place where it is so important for so many different companies to preserve and to amplify that they are willing to continue to pour money into this company? I don't know the answer to this, but these are the questions that I have this morning.
I'll say this. I haven't started to wander. I've been wandering for quite a while.
Yes, well, and
I know I'm not alone.
Fair. But I think this only adds to that, because what is the purpose in having this company of all companies get the compute, given the fact that other companies have much more pressing and obvious needs for it?
Because they're a customer and they might IPO. And you made a great point earlier about the fact that this is in Ohio. This is a huge, important political objective also for this administration. And I believe it's this week that OpenAI executives will actually be at the White House at the same time that this president is considering, and his team, about how they can somehow take some sort of equity stake in a number of these companies, including OpenAI.
Yeah, the conversation is increasingly about sharing the gains.
Yep.
But perhaps it needs to be about sharing some of the burden.
Well, especially given the scope of some of these numbers. I mean, again, $250 billion sounds pretty crazy, ludicrous, wild, impressive, large. And then you start thinking that OpenAI has suggested that they need about $750 billion of spend on compute between now and 2030. I mean, these numbers are becoming incomprehensible.
It is very circular. We've said that a few times. Looking ahead to Bloomberg Tech, looking ahead to catching up with Ed Ludlow a little bit later after catching up with the Nvidia boss going into the weekend. More on Jensen Huang later on this morning on Bloomberg TV. Let's stick with tech. 4 of the Mag 7 reporting earnings this week. Investors watching closely for clues on how hyperscalers will fund their AI ambitions. Amanda Lynam of Goldman Sachs estimating AI-related debt issuance has already reached nearly $490 billion this year, with no signs of slowing down. Writing the following: we continue to expect a range of financing markets will ultimately be required to satisfy the multi-year funding needs related to the AI build-out. Amanda joins us now for more. Amanda, good morning. Good to see you.
Thank you for having me.
So we've seen increased supply, increased demands for capital. Are you starting to see evidence it's pushing up yields?
So it's a great question. I think on the margin, yes, but it's not the main driver for global fixed income investors. Obviously, sovereigns are a big part of a broader fixed income portfolio alongside corporates. If you have an influx of corporates, they're on the margin, that could create a competition for capital, but they are issuing at different parts of the curve. And I think that's an important consideration, is that a lot of the treasury supply has been towards the front end of the curve. A lot of the corporate supply has been towards the long end of the curve. So they aren't competing head to head. I think the bigger issue for credit investors is that there's a lot of focus on the hyperscaler debt issuance. But as you alluded to, there's a broad array of supply coming from the broader tech ecosystem. And so when investors are thinking about not just issuer concentration constraints, but how much exposure do they want in the credit market to the broader AI theme if they already have equities, that's what's causing, I think, the more careful consideration.
To your point, they've been really tactical about where they issue on the curve, what currencies they issue in. We've seen that from Alphabet, a range of currencies. They've been very smart about it all year. Are we exhausting the creativity? Are we getting close to that limit?
Yeah. What has jumped out to us, actually, in that exercise where we kind of framed the AI debt issuance, which is actually harder than it sounds, by the way, what we noticed is that in Europe, the spreads had been holding in a little bit better. And when you dig under the surface, what you see is that AI-related supply hasn't been as elevated in Europe as it has in the U.S. and other regions. And so the supply dynamic is really important to monitor. I think we still have some runway in 2026 and 2027. There's a lot of capacity. We estimate over $500 billion in the U.S. IG market alone. Again, in Europe, there's room for AI-related supply to pick up. But say in the later years of this multi-year issuance cycle, this is why we expect the private markets to play a larger role, because you will start to bump up against market saturation constraints in our view.
So private markets will play a role down the line when maybe things aren't as rosy. Is that what you're suggesting?
Well, I think, first of all, there's $4.5 trillion of dry powder across the private markets, which is just an astonishing figure. So there's a lot of capital there. Typically, the private markets work best when the traditional markets aren't working the way that either folks want, or they are oversaturated, or they freeze up a bit. So private markets will charge for certainty and financing of execution. I think we should bake in a higher cost of capital. But I think there's broad demand, and you're already seeing it in the 2026 patterns, where some of these companies are actually choosing to issue in the private markets when they already have debt capacity in the U.S. So I think there will be kind of a natural evolution of, I almost think about it as a waterfall of capital markets depth. And so they'll exhaust kind of the obvious areas for capital markets depth, and then go to the other areas where the cost of capital may be a little bit higher because you're paying up for that certainty.
It's interesting to talk to different people who are analyzing the hyperscaler universe, because they say that rates going a little bit higher won't make a difference. 1 percentage point, 2 percentage point, more expensive borrowing costs doesn't move the dial. At what point have investors internalized that and said, okay, then I want 1 or 2 percentage points more? And oh, yeah, how about another percentage point? If it's existential for you, it's existential for me, and I need more money.
I think that's true. And actually, if you look through the earnings commentary of what these companies have said, company after company have talked about investing with confidence. Some have even framed the returns on the capital in the high 20% range. So even if you bake in a higher cost of debt capital, on the margin, it's still incentivizing them to deploy. And it's very clear, I think, from credit investors that this spending is going ahead. These companies are committed to this. They believe that they have confidence to do it. The question for investors is, in our view, where specifically should you be taking this exposure and at what price, especially because a lot of institutional investors have exposure on the equity side in the private markets. And so this is just a balance that we think we'll have to navigate, especially in the later years of this multi-year cycle.
Well, is this continuous, or do you think they're front-loading all the debt now for the build-out?
That's a fantastic question, because actually, if you look at cash flow from operations in 2025 and 2026, it's actually in excess of CapEx spend. So technically, if you just looked at the financials, they would have the cash on hand to do the spending, but they're issuing significantly anyway. So I do believe it's front-footed. That's probably prudent. I mean, that is prudent for a CFO or a treasurer if they know that there's this investment need coming down the pipe, that they would have the financing lined up to do it. But I do think that's notable, is that there's every reason to expect an acceleration in this, because the CapEx estimates per our own equity research analysts are only going to grow from here.
Hello, Alphabet. Felt like a front load earlier this year, right? On both the debt and equity side of things too.
And they timed it perfectly. I just wonder if they can convince everybody that they're front-loading it when they come out and increase their CapEx expenditure plans at every single earnings cycle. And that's what we saw at Alphabet's last earnings result, and that was part of the reason why you saw that pushback.
Amanda, just quickly, high yield spreads wider for 2 weeks. Should I care?
We should care. We actually flagged upside risk to our spread forecast last week.
Okay.
We're starting to feel like we're kind of hitting a tension point where the risks are skewed wider. It's been resilient. We're still tight, but I would be picking that.
What do you think that reflects?
A couple of things. Higher commodity inputs for borrowers, I think, in general, higher cost of capital. And then we've just had this persistent left tail of borrowers that haven't improved along with the broader market. And so I think that's something, again, not super focused on the maturity walls, but I think anytime you have that left tail not participating, it gives us some pause.
Interesting. Amanda, thank you. Appreciate it. Amanda Lynam there of Goldman Sachs. Loved your question. It's the right question. I think you've seen that pushback. Just below average demand for the SpaceX debt. Bit of softness was at Amazon last couple of weeks, them too. Starting to see that pushback. Just build just a little bit, just on the margin.
If you have leverage, why not use it? And right now, investors have leverage. If everyone wants to borrow money, then investors should be able to demand a greater premium, and they're doing that. At what point does it become constrictive? At what point do you start to see that being baked into the valuations of some of these hyperscalers, that suddenly they have to actually pay interest expense? They are not treated as more creditworthy than the United States government.
Equity futures this morning on the S&P positive by 0.9%. Some people might think they are, but different debate.
That's fair. OK, but they're not.
Firmer this morning in the equity market. Lots of debt coming this week. You can see why Abramovic's excited. Not about the Fed or the tech earnings, just tons of issuance throughout the week from the Treasury. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. 3 people were killed and at least 5 injured in a shooting in Seattle. The incident happened at a food festival near the Space Needle on Sunday. One suspect is in custody and another is still at large. He's not considered a public threat. Nvidia is in talks to provide a financing guarantee of about $250 billion to OpenAI. The deal will help OpenAI lease a 10-gigawatt data center hub that SoftBank is developing in southern Ohio. DeepSeek put its latest fundraising plans on hold for now. Sources telling us here at Bloomberg the company's founder is frustrated over online posts by Chinese media that he reportedly made about a June fundraising round. The unverified reports say he discussed a reliance on Nvidia chips and China's lag in AI relative to the US. And that is your Bloomberg brief. John.
Vonnie, thank you. More from Vonnie in 30 minutes' time. Up next on the programme, keeping a hike on the table.
Warsh has been nothing but clear that inflation is the Fed's #1 mandate.
He needs to do something, and we think 3 rate hikes is the way to start.
The market's not ruling out July, and honestly, neither are we.
Up next, Krishna Guha of Evercore from New York City. You're watching Bloomberg TV. Got got a Monday morning bounce. Stocks are positive, bouncing back from a week of losses. Very small losses at the index level, still 2 to 3% away from record highs. We're down up by 0.9% on the S&P after being lower by a few tenths of 1% last week, down by a little more than a half. On the Nasdaq 100 this morning, up by 1.4. Big tech earnings season just around the corner. 4 big names, massive names reporting on Wednesday and Thursday, amounting to almost a fifth of the index, which is just wild, isn't it? Trillions and trillions of dollars of market cap. In the bond market, let's talk about some supply. Let's do this just for Lisa. 2s, 10s and 30s this morning, lined up as follows, with 2s at about 430, 10s at about 460. Just bringing up the function on the Bloomberg to go through the numbers for you. Later this week, $69 billion of 2-year notes coming later on this afternoon, alongside $70 billion of 5-year notes. And tomorrow, some 7-year notes. And sometimes that 7-year can be a little bit sloppy, can't it, Bramo, in the years gone by?
It's true, just because it's not as common of an issuance as 2s, 5s, or 10s. I find this interesting. First of all, they're front-loading it ahead of the Fed FOMC meeting. They're scheduled in advance. Don't get too excited. But it's coming alongside a lot of competition. And so you start to wonder at what point you start to see yields going higher, not because of growth and inflation expectations, but just simply because of supply. So I'm watching these. I'm getting excited. What can I say?
The crowding out effect.
Yeah.
I'm right there with you. It's a race to raise capital.
Yeah, I
right
think
now.
2s and 5s are safer, but I think the long end, it's getting a little dicier.
Let's talk about this Federal Reserve. Under surveillance this morning, keeping a hike on the table.
It's all fun and games until the Fed has to pump the brakes.
Warsh has been nothing but clear that inflation is the Fed's #1 mandate.
He needs to do something, and we think 3 rate hikes is the way to start.
If you're Kevin Warsh, I think it's important to go hike when you can.
The market's not ruling out July, and honestly, neither are we.
So here's the latest this morning. Investors ramping up bets the Fed could hike interest rates this week as whip-soaring oil prices cloud the path forward. Krishna Guha of Evercore expecting Kevin Warsh and the Fed to remain on hold, writing, hiking now with no obvious preparation or context would invite rate overshooting. That would be a roll of the dice. Krishna joins us now for more. Krishna, welcome to the program. What kind of descent, if they do keep things on hold, are you and the team expecting?
So I think you would get at least 1 descent. We would guess 2 probably if Warsh keeps rates on hold this week.
Krishna, do you think that does the Fed chair a bit of a favour? That's part of the conversation we've had in the last week. Do you think that would help him out?
Yeah, certainly. Look, Warsh wants to indicate that he is in control. He doesn't want to look like he's being pushed around either way by other folks on the Fed. But having a message from the committee as a whole, including through dissents, that they're serious about inflation, and implicitly they will follow through on a September horizon if the data, war and oil warrant it, could suit him quite well.
Krishna, if the Fed were to hike rates this week without proper preparation, in your view, what does an overshoot look like? Do you expect the market to price in 75 basis points of rate hikes or more? I mean, what is the ramification for markets?
So first of all, I think if we get a hike, the market will shoot first and ask questions later. It's dangerous to just fire a hike out without any kind of explanation of what your strategy is, what your context is, what you're aiming for. Of course, Warsh could try to put some guardrails around that, but that would require providing the kind of forward guidance that he disdains. He could certainly take a page from Powell's book, say, look, what we have in mind is a limited mid-cycle adjustment, 2 or 3 moves. That would help sort of, contain the market response. But of course, Warsh doesn't want to do that. And if he instead just says, look, it's a one-off decision, we'll make the next decision at the next meeting, I do think the market will price at least 2 or 3, probably 3 hikes. The problem is if he's really serious about getting inflation down a lot faster than would otherwise be the case, then he would have to raise rates by a lot more than 2 or 3 hikes. I don't think that's what he's got in mind, but the market would be left trying to figure out what is the plan here.
There is a school of thought, Krishna, that 1 or 2 rate hikes could potentially, just along the margins, dampen some of the capital markets activity and the risk-taking appetite to at least slow down the pace of issuance, the pace of some of the meat that's been going into the mill, the grist for the mill, to try to generate some of the AI-related inflation. Do you believe that that's true? I mean, do you think that that could be a motivation to raise rates just a couple of times and that it could be effective?
So I think that's a really interesting point. I do think that Walsh is interested in the idea that by injecting just a little bit more uncertainty into financial markets, he can, sort of push risk premium out a little bit and prevent excessive risk-taking in markets. I think that he does have some sympathy for that view. The question is, you got to be careful you don't push that too far and do something that accidentally triggers a bigger market correction. You won't want to own that, certainly not early on in his tenure. The larger problem is that if you raise rates a few times at the front end, but it's clear it's only a few times, then what happens is that hits your low-end consumer on payday loans or extended on credit card debt. It hits your small businesses that are borrowing off of floating rate debt. It doesn't really have any effect at all on AI hyperscaler capex.
Krishna, do you think the fact that the president took a pause when it comes to Iran and you have Brent crude, WTI falling this morning is giving the Fed a little bit of breathing room?
So I think that is right. It was at least a fortuitously timed pause, shall we say, from the perspective of the Fed. It makes it easier for Walsh to explain if it is a hold, why it's a hold, and why that's still consistent with his intention to assert the Fed's credibility on price stability. But again, there's an irreducible level of uncertainty here because we have no strategy, no playbook from Walsh. So I can't take that probability to zero, even in today's better oil environment.
It's a new world. Krishna, appreciate it. Thank you. Krishna Guha there of Evercore. That speaks to the limited move we're seeing in the bond market this morning off the back of a pretty big move lower in crude.
Yeah, and this is the reason why people are looking at distillates, people are looking at the volatility, and people are saying ultimately the inflation is coming from myriad places, and they may have to respond this week.
I am getting messages, though, from viewers talking about the fact that hostilities did stop right before a Fed meeting. And potentially, does this give the hawks and the FOMC an excuse to pause their push for a hike right now? I don't know. I think there's a lot of factors right now that are probably influencing the president's decision. You talked about General Kane, where oil prices are, maybe a Fed meeting. But it is interesting timing.
My view would be as follows. If you were making an argument for higher interest rates based just on the price of crude, I don't think you had much of an argument to begin with. That's what I would suggest. So does this help them maybe on the margin? Possibly. But if your argument is collapsed for higher interest rates based on a 7-8% move on crude, I think you should maybe look for a new job.
On one day, nonetheless.
Right.
Which is why maybe you're not seeing the same kind of bond
Tell us more about that meat in that mill. That's a new one.
All right, I can't do expressions.
Neither can I.
I know, and
Neither
I keep trying. I once said you can't beat a dead drum with a horse.
Yeah, that's a classic too. I'm here for it, Brown. Got a long week ahead of us. Up next, we'll catch up with a big bear on Wall Street. I'm not sure Savita would call herself that, but she joins us next. Savita Subramanian of Bank of America and a whole lot more.
We'll start to get into the part of the programming where we pick some real winners and losers.
Hyperscalers will have to show more signs of pricing power and monetization.
A wide swath of the market has been largely overlooked by investors.
The pace of earnings is just not going to be what it was.
Money will rotate back into tech.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. 90 minutes out from the cash open, the opening bout just around the corner. Futures positive by 0.9 on the S&P, up by 1.4 on the Nasdaq. A rally in stocks, a rally in bonds. 2s, 10s and 30s. Yields lower across the curve just by a bit, down 2 basis points. The 2-year around 430. Off the back of this move in crude. WTI and Brent down across the board. Brent crude this morning down by more than 7%, $89 a barrel, as we shape up and line up to face down this week. What a week ahead. In many ways, I know it's not much of a promo for a show that's on every day this week, Monday through Friday, but the week begins on Wednesday. Federal Reserve decision Wednesday afternoon, and then the tech earnings begin. Microsoft, Meta, Apple, and Amazon.
So Wednesday is a big day. I will say that before then, you should also still tune in. Because there's a lot of things.
Weekdays at 6 a.m.
You have, of course, Treasury auctions, and you've got other earnings as well from Coca-Cola and UPS and Ford and Visa. So you get a sense of the consumer. I could keep selling it all day long. Either way, it is going to be most important to see exactly what type of reaction to the tech earnings there is in markets. So far, we've seen a pretty disappointing one. And I go back to what Lisa Shalett of Morgan Stanley said, which is that is important. Pay attention because that signals a narrative shift. And right now, more is not more, in her words. If you keep borrowing money, if you keep wanting to raise your capex, this market is going to say, hold on a second, what are you spending it on? And we're not sure we want to be on board.
I think people appreciate the honesty sometimes, Bramo. You know, you don't need the clickbait. Sometimes you just say the week begins on Wednesday, the schedule is light over the next couple of days, then things really start to ramp up.
Okay, but let's say UPS comes out and says, nobody wants to ship anymore, and we're actually worried about the economy.
Then you've got a crisis.
Then people care. I mean, then it's like, suddenly people care. I mean, it might be an issue of a union or whatever, but like there are...
Is that what you're expecting from UPS?
There's about 35% of the S&P 500 reporting earnings, not just the hyperscalers.
There's a potential the week actually does start before Wednesday, though, and that'll be if the president decides to resume resumptions of attacks on Iran. We've been talking about these two choke points right now that are critical. Strait of Hormuz, no one's going through it. You have issues over the weekend between the Houthis and Saudi Arabia when it comes to the Red Sea, Bab el-Mandeb Strait. Caspian Sea, there's issues. China's starting to import a little bit more. And the president might decide after this weekend, after they paused, he might decide it's now time to resume. And then potentially you're going to have another huge spike in crude.
I've got the world's greatest piece of software in front of me. It doesn't have a crystal ball. I'm just saying, based on a schedule. Anything can happen either side of that schedule, but based on the schedule, things are quiet until Wednesday.
Fine, I'll give that to you.
Okay.
Wednesday and Thursday, you've got about a fifth of the entire index report.
There you go. Can I pick up on the Lisa Shalett point? I think it's the most important point to this market. This was always going to be the issue. Earnings season, the bar for earnings season was always going to be sky high. We had a really positive earnings shock to start the year. The bar crept higher. In fact, it ramped higher coming into Q2. Can you meet it? Can you beat it? And even if you beat it, what do you learn about price and positioning? And I think Intel was just a really great example of a stock that had a run-up of 170%, something like that, into the earnings print. Earnings come out. You wake up that morning after the earnings have come out, the stock's up and everyone's saying, blowout numbers, fantastic figures. We sat around this table and we said, I remember a time when Intel would rally 10, 15, 20% over the last year off just a small kernel of good news. They had a fantastic quarter, the stock barely budged, and then it was lower into the close, into the weekend. And to Lisa's point, when markets stop rewarding good news, or parts of the market stops rewarding good news, Lisa Shalett is making the argument that the narrative's changed, and I think that's an important argument to make this morning.
Maybe markets have pre-rewarded some of these companies for good news that they're now delivering, and then they're selling the actual news, because Intel stock's up 150% so far this year. So they used to be able to rally 10% on really good news, but now they don't have the capacity to do so based on how much has been baked in. Question now is, how high is the bar to actually outperform? And ultimately, we don't know that answer.
The week begins on Wednesday. Now, it started right now. Coming up, we'll catch up with Savita Subramanian of Bank of America.
2 hours ago.
As a relief rally lifts markets. I wasn't here for it. I don't know who that was. Just somewhere else.
Evidently.
Tyler Radke of Citi joins us in a moment, saying investors should brace for higher capex from Microsoft. Lindsay Piegza of Stifel as a divided Fed gears up for a rate decision. We begin this hour with stocks kicking off the week higher ahead of a massive slate of tech earnings. Savita Subramanian of Bank of America has a street low 7,100 year-end price target on the S&P and writes the following. Underlying earnings growth remains strong, but good results are no longer enough to move the needle in tech. Savita joins us now for more. Savita, welcome to the programme. I'll start with a large question, and I imagine it involves a complex, long answer, and you'll have space for that. But why is the outlook for the index right now, in your mind, so compromised?
Yeah, lots of different reasons. But one is what we've been talking about and what I've been listening to on the show so far. The good news for tech seems to be priced in. The companies are no longer rallying and outperforming on beats on earnings and revenues. In fact, they've sold off on earnings and revenues. We've had an environment where the rest of the market is actually pretty healthy, but I think it's all been obscured by the elephant in the room, which is mega cap tech. And the idea that these stocks are going to continue to lead us to new highs, I think is no longer the case. Look, I like tech. I think tech is the future, but I think right now we're in an air pocket, and we've been talking about this all year. You know, the idea that we're in an environment where we know that we know AI. We are bullish on AI. We know that companies are spending a ton of money. ISM is above 50, well above 50. You know, CapEx is strong. The economy is strong. Inflation is pretty healthy, maybe even overheating a little bit. But the idea that we're going to see that same leadership from the ballast of the market, I just think is very hard to paint. On top of that, you've got an environment where the consumer has been chugging along, defying all expectations, and maybe that continues. But this year, I think what we've seen so far is a little bit less bullish. So, for example, if you look at layoffs in January, they were primarily in high-paying jobs, in tech jobs. It's been an environment where the higher income cohort of the S&P, or sorry, of the U.S. economy is not necessarily feeling as healthy as they were a couple of years ago, whereas lower income is now getting a boost. So I think that's healthy in terms of broadening, but it's not necessarily, kind of the same story we've seen for the last 3 years.
Savita, I'm just curious, is your 7,100 expectation just that tech has further to sell off and the rest of the market can keep outperforming or chugging along here, but it won't be enough to offset those losses?
Yeah, exactly. And I think we've kind of seen that in certain weeks where you have really negative tech moves. You haven't necessarily seen the market hold up as well. Ideally, we get to the end of the year and we're at a point where the concentration risk in tech is lesser, and you can kind of set yourself up for a healthy 2027 in terms of broadening, in terms of kind of cyclicals just outperforming. But I think this year we're still in an environment where tech is contributing the lion's share of earnings. They're no longer rallying on good news. We're seeing CapEx penalized, and we talked about this earlier in the year as well. You're still in an environment where you're getting positive returns on your CapEx if you're a big tech company, but those returns are thinning. And the idea that we're going to pay such a high multiple for mega cap tech today is hard to sell if your returns on invested capital are actually starting to get depressed.
Savita, I just wonder the sort of counter argument to this is what happened with Meta and Alphabet late last year when they announced a lot of CapEx and they were punished severely for it. And then they delivered these incredible earnings on an ongoing basis. And once again, their stocks outperformed. Why are we not set up in the same way? If people are just getting nervous and still see companies delivering well beyond any expectations.
Yeah, I think that it's partly positioning, right? I mean, you look at when tech sells off, then you see it kind of come back because investors are like, okay, these companies aren't broken. I still want them as core holdings in my portfolio. Maybe I'm going to add a little exposure. So I think liquidity has been a big driver of tech really holding up better than one might expect. Liquidity has been amazing. I mean, if you think about it, this year we've had pretty low levels of volatility in the market. We've had, a shock or two in terms of geopolitics, but the market has held up quite well. And I think that starts to change today, because if you think about inflows into equity markets, we're at a point where asset allocations are pretty healthy in equities, maybe not as healthy as they were in the tech bubble, but we've got, less cash sitting outside of equities, except for in retiree balance sheets. And I think the idea that you're going to continue to see that machine of cash risking up and going after tech stocks, that narrative to me just seems like it's less likely in the years to come. I do think there is one pocket of the market that is going to catch a very strong bid, and that is inflation-protected equity. And here's the idea. If I'm a retiree and I've got, like $7 trillion in cash just sitting there, it's been sitting there since the Fed started hiking interest rates, that cash right now has a negative real return. Cash is the worst place to be during periods of higher inflation. So retirees, I think, are going to start to look for inflation-protected income. Are they going to get it in tech? Not necessarily. I think they go back to things they used to own, like REITs and utilities, MLPs, kind of the yieldier cyclical areas of the market that can actually grow with inflation and keep up and return capital to retirees who need income, basically. So I think that's one area of the market that hasn't moved as much as it should. And that's where we would really be, very bullish. So I guess just to put a point on it, if you had to pick an index, it would be large cap value, yieldier, kind of cheaper stocks that offer some inflation protection.
Savita, appreciate the explanation. It's good to see you, as always. Savita Subramanian there of Bank of America does not like the SPX as an index, market cap weighted, but there are reasons to like stocks and other things in other places.
And we've seen this, frankly, in the way that people have been voting, in the sense that the equal weight has done significantly better. And you've all actually seen the Russell 2000 outperform, even with rates higher. So why? And this is the reason why.
It's a tech scare. It's not a growth scare. That's the issue.
Problem is, can you get a tech scare without it infecting everything else?
Given the wealth channel, the importance of the wealth channel, yeah, I think that's a really important question.
And I think that that's one that increasingly people are going to have to look at.
Let's see what this morphs into. But right now, you've got a shock into bonds. You've had a shock into energy. We're just waiting to see if that materializes into a growth scare this Fed might have to respond to further down the line. That's what you've got to wait at the Fed as well, right? You can see reasons to hike now, but there might be people on the committee worried about things transpiring in the future that might give them a reason to cut. And you don't want to be that central bank that hikes and then cuts. No one wants to be that central bank.
Yeah, I mean, although if you're going to get rid of forward guidance, maybe you can get rid of any kind of consistent patterns. Hike one rate, one meeting, cut the next. But you're right. Maybe people are looking ahead and saying, if there's going to be a tech sell-off, what are we going to do with that? You don't want to necessarily benchmark to the stock market, but the wealth transmission has become that much more powerful.
That and the amount of capex into this economy, it's become like one trade in the equity market and one engine in the economy. In some ways, I'm stretching the truth, of course. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. The U.S. pausing strikes against Iran for a third straight night. Washington's ambassador to the UN saying President Trump is giving diplomacy, quote, some space. Iran halting its retaliatory strikes and holding talks with Oman over the Strait of Hormuz. Israeli Prime Minister Benjamin Netanyahu plans to travel to New York to attend the UN General Assembly, despite a clash with New York City Mayor Mamdani over the International Criminal Court's warrants out for his arrest. Mamdani had called Netanyahu a war criminal and said he is not welcome in New York City. A dangerous heat dome is gripping the central United States, pushing temperatures and power demand higher across the plains, Midwest, and Mississippi River Valley. More than 100 million people are under extreme heat, with some areas expected to feel as hot as 116 degrees. That's your Bloomberg brief. John.
Vonnie, thank you. Appreciate the update, Vonnie. Thank you. More from Vonnie in 30 minutes' time. Up next, the morning calls, plus Tyler Radke of Citi saying to expect big spending from Microsoft. Microsoft reporting in a few days' time. Live from New York City this morning. Good morning.
The leverage and the debt for most of these hyperscalers are still relatively small. So I think you could see collectively the group able to fund somewhere about over $1 trillion next year and even more in 28, even if it means raising their debt to equity.
Frank Lee of HSBC on a tech story so far. So far this morning, the pushback sounds like this. This equity market has stopped rallying on good news. You've heard that from Savita Subramanian of Bank of America moments ago. You heard that earlier on this morning from Lisa Shalett of Morgan Stanley. We've had good news. Earnings have been great. Earnings have been tremendous, fantastic for that matter. Alphabet, an example of that. But the worries are elsewhere on capex, cash flow, and price and positioning. This morning, we're higher by 0.8% on the S&P, bouncing back from a week of losses on the Nasdaq, higher by 1.3%, and tracking this move in crude tick for tick, move for move. The move in crude looks like this: Brent back at 90. So we were down by close to 10%, now down only 6 or 7. The bond market has ignored most of the move throughout this morning. So far, just shaking it off. Twos virtually unchanged. Yields still around 430 heading into this Fed meeting.
There are a lot of other reasons for people to be worried about inflation. Nonetheless, when you take a step back and you take a look at the week ahead and you talk about the performance of some of these shares in the wake of good earnings, you wonder if it would be different if oil prices were more stable. I'm serious. Or if there is some sort of sense of a backdrop that is more amenable to these companies continuing to turn their capital expenditure wheel.
Yields this morning down a basis point or two. Some of those companies, some major companies reporting later this week. We'll talk about that in just a moment. Let's get you some morning calls. First up, Bed raising its price target on Intel, saying last week's results validate the turnaround strategy. Didn't help the stock. Stock is up this morning by 1%. Your second call from Needham raising its price target on TSMC, expecting a stronger foundry business with little competition. And your third and final call from Philips Securities, upgrading Alphabet to a buy, saying its AI ecosystem should support future growth. The name is bouncing back this morning from a week of losses. We're up by 1.3%. Let's stick with tech. Nvidia said to be in talks to help OpenAI finance a massive data center in Ohio. Sources telling us here at Bloomberg the chip maker would backstop up to $250 billion. Fresh off an exclusive conversation with the Nvidia CEO, Bloomberg's Ed Ludlow has more. Ed, good morning to you, sir. Fantastic exchange. What do you make of the news this morning?
Yeah, I mean, there are circular financing concerns. They're not universal, but essentially, Nvidia is still helping to finance or backstop the biggest names that buy its chips. So what Bloomberg's reporting is two separate things in the Ohio case study. Basically, Nvidia guarantees the leases, $250 billion, but also helps its customer OpenAI finance $350 billion worth of Nvidia chip purchases. So in aggregate, that's a lot of money. Where Nvidia basically runs as the bank. The reason I say it's not a universal concern about circular financing is read Bloomberg Intelligence as one example. They actually see it as constructive for the data center space because they're saying that Nvidia gives everyone confidence. The banks themselves would be willing to lend against Nvidia's name. It gets projects moving. It greases the wheels because Nvidia's involved. But yeah, certainly Nvidia doing business with itself, the story is back.
Just quickly, you've asked Jensen about this. I know you have. How does he respond to the question and that word circular?
Yeah, so every single time to date, the response has been we do not contractually require the other party to use the financing to buy Nvidia gear. They're free to go and buy the chips from whoever they want. In this specific case, remember this is Bloomberg reporting citing sources on the Ohio $350 billion of chips. We don't know if that's the case. Nvidia didn't respond to a request for comment. None of the other parties did. Part of it's communication. So on the SK number that came out Friday when I was speaking to Jensen in San Francisco, I was like, explain the number. And he was like, well, it's 500 billion, but it encompasses everything we're going to spend and everything SK is going to spend. And net, the number's 500 billion. It doesn't really explain the direction of travel of the funding. And so that's a part of the story is giving us some detail on who hands cash to who and in what increments and at what stages.
It's an important distinction. Ed, appreciate the clarity and looking forward to the coverage later on this morning. Bloomberg Tech, a few hours away with Bloomberg's Ed Ludlow. A few days away, a massive slate of earnings coming up, including from Microsoft. They report after the bell on Wednesday. Tyler Radke of Citi is bullish on the stock and he writes the following. Cloud and AI-related revenue streams can sustain double-digit growth, but the aggressive ramp in CapEx could hurt the longer-term trajectory. Tyler joins us now for more. Tyler, welcome to the program. A simple question, I guess. How does Microsoft avoid doing an Alphabet, given what we saw last week?
Yeah, certainly was a bit of a cautionary start to the mega cap tech earnings. But I think the big difference here is that Microsoft, in our view, is still going to remain free cash flow positive, right? And so that was one of the concerns. I mean, we are expecting some upward revisions to CapEx. We are above the consensus estimates, looking at about $260 billion of total CapEx for the full year, FY27. But look, I think what makes us optimistic about this print, not only do you have the potential for their cloud Azure business to reaccelerate, but we actually think you get sort of a second leg to the AI story with Copilot. So we raised our Copilot numbers. We actually think the product is, after years of testing and selling it into the field, it's kind of hit that mainstream adoption cycle. And so we do think you kind of have two of their most important businesses bending the growth curve, reaccelerating. And so we do think that is a pretty positive development here, especially where shares are trading kind of near multi-year lows from a valuation perspective.
Tyler, this is where actually Morgan Stanley thinks that software-related companies could do really well in the wake of efficiencies that are created as a result of artificial intelligence. Are companies, though, the end customer of Microsoft, willing to pay extra for things like Copilot to offset the incredible costs that we see coming down the pike?
Yeah, I think you are seeing that. I mean, last quarter, they announced 15 million active Copilot seats. We think that number could be north of 20 million this quarter, so adding more than 5, potentially 10 million seats to that. And I think more importantly, one of the big developments you've seen over the last 90 days is this focus on right model for the right job, model efficiency, model routing. And as you think about Microsoft, they have their own AI models, some of which are actually powering Copilot. They've been reducing their internal spend on OpenAI and Anthropic, but they also support a full fleet of both proprietary frontier models as well as open source. And so I think companies don't want to be locked in, right? We're seeing these models leapfrog each other basically every release, every week. And so having somewhere centralized where you can run, both to the specialized models, but also the frontier, I think is very lucrative. In a lot of our survey work, Microsoft stands out as still the #1 kind of enterprise AI vendor from that perspective.
I'm sure Microsoft knows that you're not going to have a good response in markets if they announce a huge CapEx plan going forward that significantly exceeds expectations. Why would they? Is it still existential to keep spending at these levels?
Yeah, look, I don't think in our view, right, I mean, you have a lot of large capital expenditures. Microsoft does not stand out as irresponsible in our view, right? You look at their CapEx as a percentage of revenue, you look at their ROIC relative to some others in the space. And look, last quarter, what did they tell you? 2 quarters ago, they said our Azure business would have been growing several points faster. Like, they are sold out for quarters, right? So it's not like a situation like we saw from Meta where they have excess capacity that they're going to go and resell, right? So their core business, their revenue would be growing faster if they had this capacity. So in our view, this is not some speculative investment where the returns are unclear, where there's no real revenue, near-term revenue potential. So I do think it is in their best interest to spend. Conversely, if they were to come out and cut CapEx, I also think that would be viewed negatively just because, why would they be cutting CapEx when everyone else is raising?
Classic rock and a hard place. Tyler, thank you. Appreciate it, sir. Thanks for the coverage. Tyler Radke there of Citi on Microsoft reporting in a few days' time. Up next, we'll catch up with Lindsay Piegza of Stifel with policymakers divided on whether to hike or hold. Plus, Yahira, has your morning move as a potential new deal between Nvidia and OpenAI has those 2 names on the screen right now rallying in the pre-market. "60 minutes out from the opening bell, stocks bouncing back from back-to-back weekly losses on the S&P and Nasdaq. We're up this morning by 0.8 on the S&P, up by 1.3 on the Nasdaq 100. In the bond market last week, 2s and 10s, double-digit gains on 2 and 10-year bond yields. This morning, declining by 1 basis point to 3 basis points lower. On a 2-year, 431. On a 10-year, around 464. Not a big rally in the bond market off the back of this move in crude. WTI and Brent. Brent crude this morning down by something like 6%. Off the lows of the session and back into the 90s at $90 a barrel. 13 days of strikes and a 3-day pause and some two-way risk to the week ahead for the situation in the Middle East.
Well, potentially what you're seeing as well is Saudi Arabia coming out and talking about the fact that confirming what happened with the Houthis going after their energy installations. So even though we have the President of the United States hitting pause when it comes to the strikes on Iran, there's another choke point that the global energy market needs to deal with. Potentially that's why we're back in the 90s. But where this goes, it is anyone's guess from here. What we do know is that we are living on low level of inventories while the conflict is still brewing.
It speaks to the limited move you're seeing in the bond market. And bring up yields again, and you can see it. 2s out to 30s. You're seeing a pretty small move lower following a double-digit yield move on 2s and 10s through last week. Why? You kind of outlined what's happening with crude, volatile, uncertain. But also, it's only one part of a much, much bigger story and might not be the key part for many of the hawks on the committee that are making the argument to hike rates.
You even had some of the previously dovish members come out and talk about the AI inputs, the CapEx spend, and how much that's really gone into the inflation that we've seen. Also, you're seeing it in other areas as well. How do you distill the prices of oil in real time from the distillates that are the products that actually are considering continuing to have elevated pricing? It's very difficult, which is the reason why a lot of companies have been passing along the increasing costs, and thinking of airlines in particular, to offset those increased costs and the volatility in their bill. This is the reason why it's hard to really just overlook a one-day move.
Imagine unemployment was close to 4%, and the government came out and said, we're going to have a $1 trillion spending plan. everyone would be like, where's it going to go? What are you going to buy? And then they say, we're going to do it for one sector. And people would start to worry about the kind of price pressure you'd see. We're basically seeing a $1 trillion spending plan come from a handful of tech companies doing the same thing with unemployment close to 4%. Is it any surprise that you're starting to see some price pressure build here, there and everywhere when the economy was already in a decent place to begin with? Things are picking up again.
Why do you think your iPhone is getting more expensive? Because of the memory chips that other people are putting into it.
And Bramo, people are paying for them.
Exactly, because they have the extra wealth from their investments. And the wealth effect has been a huge driver of a lot of the reason why people keep spending. So it comes into the circle where you said it's the engine, it's the driver, it's absolutely everything when it comes to the trade of the U.S. economy this year.
All of the above. All of the above. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We are seeing a rally across the tech trade ahead of those big tech earnings. And we start with the neo clouds. They are surging on a reporting that Nvidia is considering a $250 billion financing guarantee for an OpenAI data center in Ohio. And bigger picture, the way our analysts here at Bloomberg put it, is that the reason the likes of Nebius and CoreWeave are higher is this reinforces confidence in both demand for compute capacity and that the funding for the next wave of AI data center projects is there and available. Turning to the chip sector, that is also staging a rebound this morning with names like Intel up 1% after a tough sell-off on Friday, even after it posted stellar earnings. Yes, easing tensions with Iran is helping this trade, but the real catalyst will come later this week when the hyperscalers report. And if Meta, Amazon, Microsoft raise their CapEx plans, it would signal that demand for these chips is going strong as part of that AI build-out. And we end on D-Wave Quantum. Those shares up 7.4% after the company announced a partnership with AT&T. And the idea here is that the telecom giant will use this quantum computing technology to help make its network more reliable, including spotting outages quicker. So hopefully all this means is better cell service for all of us. John.
Yara, thank you. Appreciate it. Appreciate that too. The Fed's two-day meeting kicking off tomorrow ahead of a rate decision on Wednesday. Mike McKee is down in Washington already, preparing for the major event a few days away. Mike, how live is this meeting for July?
Oh, it's definitely very live, John. We've got an economy that is strong. We've got AI that is growing like crazy. Just a few minutes ago, we got durable goods orders in, and while they come in lower than anticipated, up 0.3% compared to the 1.8% forecast, computers and electronic products up 3.1% in that report. So definitely some AI influence going on. And the Fed has been worried about AI inflation going forward. They're worried about a lot of things, but here are the reasons why they might do one thing or might do another. You want to look at reasons to hold. Even though we're seeing AI inflation, June CPI and PPI slowed, and the PCE is forecast to slow as well. That comes out the day after the Fed meeting. And what would it look like if they raised rates to fight inflation and then the next day their target inflation went down? Hiring has slowed, of course. Tariff inflation is fading. We got new tariffs last week, but they really don't change the percentage change in what people are going to have to pay. And the economy doesn't seem to be overheating. Atlanta Fed right now says 1.7% for the current quarter. But there are reasons to hike. The renewed war pushing prices higher again, especially for energy. They're down today, but they have been up, and gasoline prices are certainly up this morning. Inflation has been above target for 5 years now, and some members of the Fed saying that's way too long. We got to get serious about this. Financial conditions, if you look at it, are easy, and you've got all this borrowing going on in the AI world, and it's got to have some influence on overall asset prices. Are they too high? And also, the last one is, of course, that raising rates, Kevin Warsh would build his credibility in the markets. The question of whether he's a captive of the president would go away. If they don't do it tomorrow, or Wednesday, rather, this is what's coming up. We've got 3 more FOMC meetings before the end of the year and Election Day on November 3rd. So that probably takes out one of those meetings. But they could set up for September if we see prices continue to rise for energy, and the expectation is we get inflation ahead. We get 2 more PCE reports, 2 more CPI reports, and 2 more PPI reports before we get to that September 16th meeting. So the Fed would have a lot more data, though whether or not Kevin Warsh wants to talk about what might happen ahead is still an open question.
Mike, I was ready for the weekend early last week. It sounds like you're ready for the end of the year already. Mike, appreciate it. Mike McKee down in Washington, D.C. Can we bring up that calendar again? Key dates for the Fed. This is why the president calls it the easiest job on the planet, right?
Yep.
Isn't this what he calls it?
He
Right?
calls it, it's like
That's
flipping,
the year ahead. That's the year ahead.
It's like a coin toss, flipping a coin.
They've got a few more coin tosses to go. September, November, we've got the election. October, you got that meeting late October, then December. Brammer, you looking forward to December 9th? Shut it down.
Shut it down. I'm looking forward to what we're going to see on Wednesday.
What
I think
does
it's
the
going to be
world look
fascinating.
like in December, right? Can you even think about that far out right now? I feel like I've been doing it week to week, day to day for the last 5 months.
We'll be 8% up, and we'll have just sort of a mild
call.
increase in rates, but the Fed will be on hold still by December 9th.
When I start to think about how this year has unfolded, I'm reminded that we were all off our holidays and the new year when Nicolas Maduro was captured.
Yes.
And then that was the tone that was set for the cadence of the news flow this year.
First quarter felt like a lifetime. Since the first quarter ended, blink of an eye. Blink of an eye. Here we are at the end of July.
I feel like it's because we were supposed to have fun, and we didn't really have it.
That's what you were looking for, Bramo.
See, everyone comes in, they say, like, well, summer was supposed to happen, and it never has. Like, the summer has been incredibly busy. Everybody who's come in has actually said that. Have you not heard that?
Yeah, I've heard the same thing.
So there you go. So it's just gone by
underwater
very quickly. Yeah,
everyone is
and
in
not
the deep
underwater
end.
in the good way.
Lindsay Piegza has been busy. She writes the following over at Stifel. For policy, just as in politics, conflict often begets gridlock. As such, rates are likely to remain on hold, at least for some time longer. Lindsay joins us now for more. Lindsay, welcome to the programme. On hold then, but just describe what the debate might sound like that starts tomorrow and concludes on Wednesday.
Well, I think Mike really laid out a lot of the factors. When you look at the latest inflation data, the disinflation data, I think that clearly swings the pendulum into the dovish camp, giving them credence for the fact that price pressures may abate into the end of the year if we do see the impact of tariffs fall off, and if we can see some sort of normalization in the energy market. On the flip side, even with this recent cooling from peak levels, inflation is still double the Fed's intended target. And with the risk of upside pressure, further rising tensions overseas, resulting in additional upside pressure in energy costs, this puts the Fed, the more hawkish members, at an uneasy position that we should take this more aggressive action and reverse some of that policy easing that we saw into the end of last year. So, as I suggested, this ongoing conflict, this clear divide between the hawkish and more dovish members is likely to result in policy simply remaining steady, on hold for the next several meetings.
Lindsay, what do you make of the point that Krishna Guha was making earlier, which is that the Fed were to hike rates at this meeting, that the market would price in 3 or 4 rate hikes immediately, that they would shoot first and ask questions later? Do you think that that's the likely path of travel? Should they move this week?
Well, I think it depends on the communication that accompanies that decision. But if there's a lack of communication and the Fed simply comes out, makes that aggressive move higher without any guidance, any forward guidance for what we can expect going forward, I think the market would anticipate that the Fed has shifted their line of thinking to the prospect that inflation is rising, it's not under control. And if that's the case, it would be unlikely that one rate hike would quell that concern and convince the committee that inflation was back on a pathway to that 2% target.
Lindsay, it's incredibly unusual, and you know this very well, that when you see an increase in energy prices to this degree in the face of a shock, that you get a sudden real expansion in the labor market, that you see a real acceleration in terms of job creation. How do you understand that? Because that is exactly what's happened this year, and it's incredibly unusual.
It is, because typically when we think about the economy, the fastest way to derail the U.S. consumer is by sustained heightened energy prices. And as a consumer-based economy, if the consumer isn't happy and healthy out in the marketplace spending, we can't expect much expansion or much growth then from the broader economy. But you're right, we're not necessarily seeing that. We're continuing to see this pressure at the pump, higher energy prices, but the economy is still expanding. Now, certainly not at an overly robust pace by any means, but we maintain this decent pace. And as we look out to the second quarter, we're likely to continue around this 2-ish% with still stable conditions in the labor market. Again, we have lost some momentum, but the average pace around 100,000 per month does suggest that the latest pathway of higher energy prices has not yet derailed the consumer or the broader economy.
Lindsay, do you expect dissenters this week?
I think it depends, again, on that rate decision. If for some reason we see the Fed come out and decide to make a policy move, absolutely, I would expect to see some dissensions. However, if we see the Fed take the more steady pathway, maintain the current level of policy, as I expect, the dissents may be reined in if there is a very ample conversation around a potential move in one direction or the other down the line.
We've been having this conversation all morning, and Blake Gwinn of RBC was talking about it, that he actually thinks the dissenters, if they hold, could help Kevin Warsh. Do you think that gives him cover?
I think right now, Kevin Warsh very much would like to steer the monetary policy ship to a lower interest rate environment. But I think right now he recognizes that that's a more medium to longer term outcome. Given the level of inflation, given still the upside risks, I think at best Warsh can expect to hold policy steady and along the way simply downplay any prospect for interest rate hikes, even if the conversation begins to move in that direction.
Lindsay, it's good to see you. It's great to get your reaction. You look ahead to this Fed decision. Lindsay Piegza of Stifel, in some ways reflecting the consensus view right now, which is unchanged. Hold. So where does the two-way risk come from? On the margin, it comes from the hawkish elements of the FOMC that's made a lot of noise coming into this meeting. I'm thinking of Beth Hammack, the Cleveland Fed president, with a LinkedIn statement going into the previous weekend, making her thoughts clear on things into the blackout period. It also comes from the lack of guidance from the Fed chair himself. This is the kind of move that he wants, the kind of mood on Wall Street that he wants, which is some two-way risk and get away from the hand-holding. And I think maybe it's more of the latter than it is the former right now. Typically, if a Federal Reserve moves and goes to hike interest rates, there would have been a piece in a Wall Street Journal earlier this week, right? There would have been a report, something indicating in the blackout period they were close to that, and that's not the world we live in anymore.
Well, interestingly, a lot of people say that that was actually the prior Fed chair's goal, and actually that's what he did in terms of the forward guidance, and that before that there wasn't the same kind of tradition of a story in the Wall Street Journal guiding the rest of the market. Question a lot of people are saying is, what purpose would it actually have right now? Would that actually dampen inflation? And I think that that is the answer. That just is less clear.
Yields this morning down a few basis points off the back of a sell-off in crude. Let's see if that holds. Let's give you an update on news elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Maine Democrats tapping former Republican Troy Jackson as their nominee for a pivotal Senate race. Jackson replaces Graham Plattner, who bowed out after rape allegations. A University of New Hampshire poll showing Jackson leading five-term GOP incumbent Susan Collins by 3 percentage points. Oil sinking as the U.S. pauses daily strikes against Iran. Brent tumbling and trading below $90 a barrel. WTI also falling along with European natural gas. And the CME is launching single stock futures today, allowing traders to hedge or speculate on more than 50 of the largest U.S. companies. The contracts will be cash settled on the closing price of the stocks they're tied to. Trading will be open 23 hours a day, 5 days a week. That's your Bloomberg brief. John.
Vonnie, thank you very much for this morning. Appreciate it. Up next on the programme, we'll set you up for the day and a big week ahead. Plus, we'll catch up with Holly Liss of BTG Pactual as Wall Street awaits a crucial week of big tech earnings.
When the market stops rewarding good news, you have to pay attention because it signals that the narrative is changing. For us, we're focused on this idea that more is no longer more. More CapEx spending actually is starting to worry the markets about when I get a return on investment.
Lisa Shalett of Morgan Stanley, when the market stops rewarding good news, is that where this market is at this morning? Just bring up the week ahead. And let's look at those 4 tech names that report on Wednesday and on Thursday. You'll hear from the likes of Apple, Amazon, Microsoft and Meta Wednesday through Thursday. How high is the bar for them? They're all different companies, of course, and Apple, of course, is an outlier in many ways compared to those names on the screen. But after the experience of Intel, following the experience of Samsung and others, you can pick others. Are we at this point where this market stopped rewarding good news because we are starting to learn more and more about price and positioning.
You know, it's really important that you mentioned Intel and Samsung when you were giving that narrative, because it isn't just the hyperscalers. It isn't just the spenders, as you pointed out many times. It's also the receivers of that capital also underperforming after reporting really good earnings. Does that just mean that in general people are souring on tech, that their tolerance for gains that have been so massive just isn't there anymore? Or is this something that just simply is a sort of risk-off move that's going to then reassert itself as risk-on later in the year?
And then potentially, how vulnerable is the market going to be to anything we hear from Kevin Warsh, the fact that we have these big tech earnings this week? I know we're on air Monday to Friday, but Wednesday's really when it starts. And also, I look forward to Wednesday because extra innings, when I get to watch you two do more hours.
Oh, nice. Nice, okay. That's a good way to start the week. You see Bramo's impressed face.
Well, come on. I love the extra innings you guys do.
It's kind of you, thanks. Do you want to join us?
I like watching.
You're busy?
I like being a viewer.
You're busy on Wednesday
And, you know, just
okay.
I being in some thoughts.
Special coverage, 1:30 Eastern Time, with Annmarie, hosting solo, going into the Fed decision
We'll
at 2 p.m.
pizza.
Eastern. Yeah, we'll watch from home. Okay. Stocks pushing higher this morning ahead of a massive week on Wall Street. We've got those big tech earnings and that Fed decision and special coverage of that Fed decision right here on Bloomberg TV. Lisa will be here. Tom will be here. I'll be here. Holly Liss of BTG Pactual joins us now for more. Holly, welcome to the programme. That high bar for tech, let's just start there. We've heard from a series of guests this morning that are becoming increasingly convinced that because this market has run up so much, particularly the chip players and other tech names, that we're stopping rewarding good news. Do you share that view?
I don't necessarily share that view, John, because look at this morning. We see oil prices are down 6% and the market is rallying. S&Ps are up, yields are down, the 10-year futures are up. So I think we are still rewarding good news, and I think that can continue.
So what do you make of some of the price action that we saw in the past couple of weeks? And John mentioned a few of them, whether it's Intel, whether it's Samsung, whether it's Alphabet.
There is difficulty sometimes with pricing things, not seeing the earnings yet until you get them. But I think as long as the Fed is on hold, and I think that's what we're going to see through this July meeting, the Fed funds futures are only looking at odds of about 1 out of 3 for a hike this meeting. And when those Fed funds futures are most accurate within 8 days of expiration. So I don't think there's going to be any Fed action this week. So we're seeing some stability here, and that could also help stocks further.
Do you think that part of the sell-off has been this concern about coming from real yields and coming from the Fed funds futures market, that the Fed could be live and that actually this could be a much more hawkish central bank?
It could be more hawkish, but I think a lot of people are taking that tone because we're also seeing a little bit less transparency with less press conference, less in the statement, less people going out there, the Fed members, and talking to the public. So I think they take the lack of transparency, or what they perceive as lack of transparency, as higher risk and therefore more hawkish statement. But it doesn't have to be that way. And we've seen CPI, PPI come down at the last report that we had, at the 2 last reports we had last week. And if that continues, I think that's giving them the breathing room they need. And given that he's being a little bit less, he's being closer to the vest with his communications, that gives him actually a little bit more flexibility to move as the data dictates. And certainly oil prices are going to be one of those inputs that he's going to be looking at.
Can they look through these oil price moves that we're seeing? I've been saying it all morning. Oil is just moving like a yo-yo, literally. 10% moves sometimes from week to week.
Yo-yo is a good definition. It was up 15% 2 weeks ago, up 8% last week. Now we're already down 6% today. So I think what you need to look at is the general trend of it. These price moves higher have been very dramatic, but now we're starting to see them coming off just as easily. If we get that on a sustained basis, especially as we move into Labor Day in the U.S., then I think they're clearly going to take note of it. They're not going to be able to not take note of oil prices coming down.
It's volatile this morning. Holly, appreciate your input. Holly Liss there of BTG Pactual going into that Fed decision later this week, and the volatility in energy. Brent crude at the lows this morning, down by more than 9%. We got an 87 handle. We're back to about 90 right now, getting closer to 91 and down some 6 percentage points. The latest out of the Middle East, a volatile situation.
Yeah, oil sites in Saudi Arabia, as we've been discussing all week, they were targeted by Houthis with drones. Saudi Arabia came out and says they intercepted a number of these drones that were going after energy facilities. Riyadh says the drones were launched by Iranian-backed militias from Iraqi territory, on top of the fact that the Houthis are also saying that they are targeting energy installations with drones. So you could see now, even though the Strait of Hormuz right now. The president's not targeting any of those assets. We have to worry about the conflict brewing on the other side when it comes to the Red Sea.
Yeah, Nathan Sheets of Citigroup actually had a really interesting note about the scenario as he tried to move away from just the near-term headlines, as all of us are trying to do. He said that in general, yes, there have been a huge drawdown of inventories, have been huge drawdowns, but there still are some high levels of inventories still available in pockets. That said, still sees the potential for $100 a barrel oil should this be as an escalation types of scenario, which they're not pricing in and people don't expect because of the midterms and because of some of these other considerations.
Is it still Monday? Still Monday? Still Monday.
I think so, and I actually thought that today was part of the week, but evidently I've been told that Wednesday is the time to actually
the week starts Wednesday.
I think that
Let's ease into this.
It's the
Let's
warm-up.
ease into this.
You know, I think that some people, Coca-Cola,
UPS. Who were the others?
They do pretty. Yeah, there are lots of them. I mean, this is a huge week, I could tell you.
Okay.
So tomorrow it's Visa, Coca-Cola, UPS.
Visa's one to watch.
Ford,
yes.
Hilton. To the sort of how many people
how's the economy doing? What you see in the financials, the banks, and I keep bringing this up, but banks have rallied for 8 consecutive weeks. I think they're up by 15% over that period. Haven't had a down week since May, I believe, for the banks. The banks doing better. There's a tech piece to that story. I know that, but if you're worried about the economy, that's not the place you'd be buying, and that's the place people are buying.
I keep going back to Capital One and the fact that their charge-offs went down so much that really fed into their profit margins. But we've heard from already American Express. People are spending.
I'm sold. I'll see you tomorrow morning.
Good.
Right.
I'm so glad you're still going to come in.
I'll be here Friday too. All right. Just Wednesday and Thursday, big days. Coming up tomorrow to break it down, Cameron Dawson of New Edge Wealth, Stu Kaiser of Citi, the former Kansas City Fed President Thomas Hoenig, and Oksana Aronoff of JP Morgan Asset Management. From New York City this morning, good morning. This was Bloomberg Surveillance.